Good morning, friends. Good morning, friends. Okay, today we're going to start with a fresh chapter which is on standard costing. This is an area which you would have anyway seen at CA Inter level. The initial 1 or 2 sessions will focus on what you learnt at CA Inter, maybe basically cover those aspects again, and then we go into the advanced set of areas. Now at CA Inter level you would have got introduced to the various cost variances. You would have learnt about material variances, labor variances, overhead variances. Here at final level computation is one part of it. Second is analysis of the same. What is analysis of the same is we will calculate the variance and then try to find a base reason. For example, if there is a favorable variance, if you have a favorable material price variance, it indirectly means that you have paid a lower price. It could be because of multiple reasons. Could be that my purchase team is highly efficient, or could be because I have bought a substandard quality of raw material. If you buy an inferior quality of raw material, you will see that the prices are on the lower side, or maybe you have changed the supplier and because of which you are able to get it at lower price, or maybe the standards which you set were wrong. You initially said you will buy it 10 rupees whereas the budget should have been 9 rupees. So one part will be calculation, the second part is going to be on getting to know as to why those variances are occurring. What could be the base reason for that? You will have to find out a reason for them and then fix some responsibility. Sometimes the purchase team could be responsible, sometimes the budgeting team could be responsible. So you will have to find out who is responsible for what variances. Also you are going to learn about lot of advanced variances. You learned the basic variances there, because what happens is I prepare a budget a year in advance. The budget may have to undergo change based on the circumstances which are there, because in the market, for example, COVID happened. If you have prepared a budget before the COVID and then you say you don't want to change the budget, then it is not logical. So organizations either have an option to change the budget or factor in the revised budget while calculating the variances, which is technically called as planning and operating variances. You have something called as planning and operating variances, which will factor in any kind of changes which needs to be made to the budget, because the conditions can undergo a change. If the conditions are undergoing a change, there is a necessity to change the budget. You will also learn about an advanced variance called as market size and share variance. What is market size and share variances? There is a component called a sales variance. The sales variance can happen because I can sell more if my market size expands or if my market share expands. So the growth is coming from market size or market share. You will also learn about standard costing with activity based costing. Activity based costing is an area which you would have learnt at CA Inter level. So how is variances calculated with activity based costing, the linkage with that. We will also learn linking of standard costing with relevant costing. Relevant costing is an area which we saw in marginal costing. So how do you factor in concept called as opportunity cost? When we are calculating variances, we will also be factoring some opportunity cost in our computation. So this is a broad overview of the chapter. I can broadly classify into 3 segments. The first segment is basic variances calculation, which you learnt at CA Inter level. Second component is understanding the rationale for your basic variances, or trying to analyze those variances. 1 and 2 will be combined together. Your computation analysis will always be together in most of the question. Few question will only focus on computation part, which is just to revise what you done at CA Inter level. So computation could be one part of it. After computation, I need to analyze those variances and then see how are the variances occurring, or fix some responsibility on the variances side. Then we'll go to, okay, there's another component called as reconciliation, that is you will have to reconcile the profit, and the final part is called as advanced variances, which is the most important part, where you have planning and operating variances, you have market size and share variances, you have relevant costing approach, you have activity based costing approach. So all those approaches will come there. So this is a broad categorization. Cost and sales variances, which is just calculation part of it. Variances with equivalent units. Equivalent units is using the concept of process costing. You would have learnt about process costing at inter level. So how do you calculate variances with that? Reconciliation of cost and profits, market size and share variance, planning and operating variance, ABC and variance analysis, relevant costing approach. These are the advanced set of variances you are going to see. Let's now get into basics of your standard costing, which you learnt at CA inter level. Now any variance has a simple formula. The simple formula for a variance is standard minus actual. Standard minus actual, that's a simple formula for a variance. If somebody wants to calculate material price variance, the simple formula is standard material price minus actual material price. If somebody wants to calculate material cost variance, the formula is standard material cost minus actual material cost. Somebody wants to calculate labor efficiency variance, standard labor efficiency minus actual labor efficiency. Some things will get added to the formula, but this is the base formula. Any variance is nothing but standard minus actual, except for few category of variances which I will explain as we proceed. For few category it is called budget minus actual and not standard minus actual. Now my first question is, what is the difference between standard and budget? Because you will keep hearing these words at multiple places in this area. Not only in this area, you will hear it in other chapters also. What is the difference between standard and budget? What is this two names? Because both almost mean the same. So what is the difference between standard and budget then? Sorry?
Wrong estimation.
Wrong estimation of what?
Wrong estimation of the budget.
Okay, so how will standard vary with the budget? I have done a wrong estimation, so I am revising the budget. That's not called standard, because revising the budget is planning and operating variances, where we use a term called as revised standard. Standard and budget, what could be the core difference then?
Budget is something that you see, and standard is something that depends on the factors.
What are the factors? You have come to the factor, you have come to more or less the right explanation, but what are the factors then? Yep.
Budget is something that you fix, standard is something the industry fixes.
No. Technically you can may say that as an explanation, but not for this, not for the purpose of standard costing. Yeah, someone else made a point.
Actual output and planned output.
Okay, perfect. So that's the core difference. I'll give you an example. Let's assume an organization wanted to produce 20,000 units. I wanted to produce 20,000 units and spend 20 lakh rupees on this. 20,000 units needs to be produced and spend 20 lakh rupees on this. This was the original plan which I gave to my production manager, saying that please produce 20,000 units and spend 20 lakh. He ended up producing only 15,000. Could be multiple reason. Maybe demand is not there, so I have reduced the production, or maybe shortage of men, material, machine, money. I have produced only 15,000 and the actual cost is 17 lakhs. Now the production manager comes to the MD and says that I have saved 3 lakh rupees for the company. I have saved 3 lakh rupees for the company. You told me to spend 20 lakh. I have spent 17 lakh. Why don't you pay me a bonus? I have saved 3 lakh rupees for the company and you have to pay me bonus in this example. This is what he goes to the MD and says. MD is literally confused now. He is thinking why there should be a bonus, because we have ended up producing lesser units, so why should I pay bonus? But the production manager keeps making the same point. You told me to spend 20 lakh rupees. I have spent 17 lakh rupees, so I have saved money for the company. Why don't you pay me bonus? Now what logical answer can you give to him? You have to give some logical answer to the production manager. So cost per unit is
Higher than the budget.
okay. So what should I have spent then? How much I should have spent?
15.
How much?
15 lakhs.
Okay, that 15 lakhs is called a standard cost and 20 lakh is called budgeted cost. That 15 lakhs which you calculate, standards are always determined with the help of actual output, or actual utilization, or actual capacity. So standards are always calculated with the help of actual performance. There is only one place where standards and budgets may not vary. Still for variance computation you will vary it, but logically it will not vary, is fixed overheads. Fixed overheads normally will not change with the output which is happening. So technically I cannot say standard cost is even 15 lakh, it can be higher also, because I need to know in that 20 lakh how much is fixed, how much is variable, because fixed costs do not, for example if this entire 20 lakh is fixed, no, I should pay a bonus to the production manager because he has cut down the fixed cost, because fixed cost is not going to reduce with the reduction in output. So as of now, if I say budget actual output is 15,000 and standard cost is 15 lakhs, standard cost is 15 lakh, and the cost variance is the difference between standard cost and actual cost. It's a difference between standard cost and actual cost. Standard cost is 15 lakh, actual cost is 17 lakh. There is an adverse variance of 2 lakh, so no bonus needs to be paid. In this case there is an adverse variance and not a favorable variance. There is an adverse variance and hence bonus is not required to be paid. Clear? Any doubts on this? Any doubts on this explanation till now? The core difference between standard and budget is this: budget is for the budgeted output, standard is for the actual output. Or technically you will have to prepare something called as a flexible budget. There is an original budget which is prepared. If you prepare a flexible budget, whatever amount you write in the flexible budget are the standards. Flexible budget is computed based on the actual utilization. So your flexible budget would be prepared based on what is the actual utilization. Clear? Any doubts on this? Now what we are doing in standard costing is we are going to reconcile budgeted profit and actual profit. We are going to reconcile budgeted profit and actual profit. It's not the reconciliation of standard profit and actual profit. There is a way to reconcile that also, but the basic thing which we try to reconcile is budgeted profit and actual profit. Now the variance in profit, the profit can vary because of two reasons. One is cost, second is sales. Any variation in profit can be because of cost side issues or sales side issue. The cost side issue can be because of material, labor, overheads. It can be because of material, labor, overheads, and this can be because of variable overhead and fixed overhead. So totally I will have 5 basic variances to be calculated: material variances, labor variances, variable overhead variances, fixed overhead variances, sales variances. There is no sub breakup in the sales variances. So you will have to understand how do you calculate all these 5 variances. Once you have understood computation of these variances, we get into the analysis part, we get into the fixing of responsibility, we get into the base reason for the variances. So all those will be the next set of analysis which needs to be done. So the first main thing is variance is the difference between standard and actual. There are few places where this will change, like your fixed overheads, it will be budget minus actual in few formula. Now the formula says standard minus actual. There are few places where we will do actual minus standard also. There are few places where we will do actual minus standard or actual minus budget also. The formula has been devised in such a manner that if you get a negative answer, you will call it as adverse variance, and if you get a positive answer, you will call it as favorable variance. That's the purpose of the formula. Technically I don't need a formula, I just can look at two numbers, find out the difference between the number, whether you subtract the bigger number by the smaller number or smaller number by the bigger number. If you think logically, then you can say which is adverse or which is favorable. For example, standard cost 20 lakh, actual cost 22 lakh, budgeted sales 25 lakh, actual sales 30 lakh. Standard cost is 20, actual cost is 22. Is it an adverse scenario or a favorable scenario? Adverse or favorable? Adverse. So standard minus actual will give a negative answer. Budgeted sales is 25 lakh. There is no concept called a standard sale. Budgeted sales is 25 lakh. Actual sales is 30 lakh. Is it an adverse scenario or favorable scenario? Favorable. But if you use the formula standard minus actual or budget minus actual, you will get a negative answer. You will get a negative answer. So the formula is called a standard minus actual. The formula will be standard minus actual for all negative factors. What is negative factors? Wherever you want to reduce them, you want to reduce cost, you want to reduce material price, you want to reduce material quantity, wherever you want to increase something, there the formula technically is actual minus standard. The formula technically is actual minus standard. We don't change the formula and all, but this is the logic. There's nothing like standard minus actual or actual minus standard. You can do any of them. You want to do actual minus standard, I don't have a problem. If you say 22 minus 20, 2 lakh, and you write adverse, then it is technically right. You just need to write adverse for the answer. Even if you do 22 minus 20 or 20 minus 22, doesn't really matter. The formula has been devised in such a manner that adverse variance will be having negative answer and favorable variance will be having positive answer, but this formula can change at few places. You will see this change happening at few places in the fixed overhead variances. Clear? Any doubts on this? Now, objective is also, the objective of standard costing is one, calculation and then fixing responsibility. Why do I fix responsibilities? By fixing responsibility, I will be able to make performance improvement. See, I wanted a profit of 20 lakh. I earned a profit of 25 lakh. That does not mean everything has gone well for the company. 20 lakh is what you wanted, you earned 25. That does not mean everything is good. That does not mean everything is good for the company. There is a possibility that company has still failed in few things. It could be that their labor efficiency is not proper, our material purchase was not proper, our material utilization was not proper. It does not mean just because your performance, for example, you had planned to score in your 12th exam, you wanted to score 1100 out of 1200. You have scored more than 1100 does not mean in all the subjects you have performed better than your expectation. There could be few subjects where you still performed weaker and there is scope for improvement, and where there is a favorable performance, you need to reward that person who is responsible for that, because for the favorable performance somebody is going to be responsible and for the adverse performance also somebody is going to be responsible. You need to penalize or reward them. You need to penalize or reward them. First thing I am going to start is with material variances. The first thing we are going to start with is material variances. You will have to write along with me few things. So write material variances. These will not be there in the material. Material variances. Material variances. Situation 1. Single raw material. Situation 1, single raw material. When I compute my variances, there will be two types of question. One type of a problem where there will be only one raw material. When I say one raw material, one type of raw material. There will be only material A. For producing the product, you are using only material A. Some question you will use material A, material B, material C, material D. That is called multiple raw material. For producing one unit, if you wanted to use 5 kg of one raw material, that is a single raw material situation. You can use 5 kg, 10 kg, 20 kg, that does not matter. When you have two different types of raw material called as material A, material B, material A1, material A2, that will come under the category of multiple raw material. There are two components of material cost. There are two components of material cost. If somebody says material cost is 100 rupees, then 100 rupees could be because of two reasons. One is the quantity used and second is the price at which you wanted to buy. So there are two components of material cost, price and quantity. Two components of material cost, price and quantity. Not writing anything beyond this, listen for some time. You will have to understand this clearly. Some of you would have seen my standard costing videos earlier, or part of Inter will find it easier, but others may find it little tricky initially. You will have to just understand this, because I don't want you to remember any of the formula. In standard costing, I don't want students to remember even a single formula. There is a chart technique which I use. The chart technique, once you understand for one time, things will become very clear. Now, in order to calculate the variances, I am going to prepare a chart. This side I am going to write quantity. This side I am going to write price. There can be two types of prices, standard price actual price. Standard price and actual price. Standard price means the price at which you wanted to buy the raw material, and actual price means the price at which you actually purchased it. Standard price means the price at which you wanted to buy. AP means the price at which you have actually purchased. There are two types of quantity: standard quantity, actual quantity. Standard quantity means the quantity which you should have used. Standard means which should have been done. The term standard means should have been always. Standard price, the price which should have been paid. Standard quantity, the price which should have, the quantity which should have been used. Standard cost, the cost which should have been incurred. Standard profit, the profit which should have been earned. Should have been. So basically standard means what should have happened. Actual means what has happened. Now in order to calculate variances, I need a computation table. So I am going to start with SP here. Connect with the first item which is SQ. SP, connect with the first item which is SQ. Again start with SP, connect with the second item which is AQ, and start with AP and connect only with the last item. I don't connect AP with SQ because I don't need it to calculate variances. I don't need that to calculate variances, so we don't connect that. So the table will have SP into SQ, SP into AQ, and AP into AQ. These three things will go in the table: standard price into standard quantity, standard price into actual quantity, actual price into actual quantity. These three things will form part of the table for a single material. Standard price means what price you should have paid, actual price means what price you have actually paid, standard quantity means what quantity you should have used, and actual quantity means quantity which you should have used. Now there are two, the main variance is called material cost variance. Material cost variance, the formula is standard material cost minus actual material cost. Standard material cost minus actual material cost. Standard material cost is multiplication of two standards, SP into SQ. Actual material cost is multiplication of two actuals, AP into AQ, SP into SQ and AP into AQ. I don't want to write anything, I will give you time to write, listen for some time. Standard material cost and actual material cost. Standard material cost is multiplication of two standards, actual material cost is multiplication of two actuals. This gets divided into material price variance, material usage variance. Material price, instead of using the word quantity we use the word usage. Material price and material usage. Material price variance is the difference between standard material price and actual material price. Standard material price and actual material price, that is the broad formula. The formula is difference between standard price and actual price, and this is difference between standard usage and actual usage. Standard usage is standard quantity, actual usage is actual quantity. Now in this chart, the gap between these two, SP and AP, the gap between SP and AP is called as price variance. There is that above part in that chart. The top part is called as price variance. The gap between SQ and AQ is called usage variance. Just give me a minute. So this part is called price variance, this entire part is called price variance. And this part is called usage variance. The blue part is called usage variance, the other part is called price variance. Now I need to arrive at the formula looking at the chart. Now what we need to do is, in order to calculate price variance, I will use two items in which the balancing figure will be this area. This area has to be the balancing figure. How this area becomes a balancing figure is, I have a bigger rectangle there is a bigger rectangle which starts from AP, there's a bigger rectangle which starts from AP and goes till AQ. There's a bigger rectangle which starts from AP, rectangle or square, whatever it is. It starts from AP and connects with the last item called as AQ. From this bigger rectangle, if you remove this portion which is below, if you remove the portion below, you will be left with the in-between area. From a bigger rectangle, if you remove the portion which is below, you will be left with the in-between area. This will give you the formula. You just understand once, thereafter all formula will only be the same logic. You have a bigger rectangle which starts with AP, connects with AQ, and you have a smaller rectangle which starts with SP, connects with AQ. Once from that bigger rectangle you remove the smaller rectangle, the balancing figure is the top part. The balancing figure is the top part. In short, the material price variance formula is AP into AQ compared with SP into AQ. AP into AQ. Why I use the word compared with, I will explain in some time. AP into AQ compared with SP into AQ. That is, this bigger rectangle starting from here till here. From there, if you subtract the smaller rectangle from the bigger rectangle, if you subtract the smaller rectangle, you will be left with that top part. You will be left with that top part. That is called as price variance. Similarly, for the usage variance, if you go, if you start from this bigger rectangle and you subtract the smaller rectangle, you will be left with this in between area. You will be left with this in between area. The bigger rectangle is SP into AQ compared with SP into SQ. SQ and AQ comparison is called usage variance. SP and AP comparison is called price variance. The only thing is the formula is standard minus actual. So you take a smaller rectangle, from there you subtract the bigger rectangle. This chart is just our creation to remember the formula. It's not necessary that SP has to be below AP. Sometimes SP can be above AP, sometimes SP can be below AP, because your standard price can be more, standard price can be less. This chart was created by us just to remember the formula. So the formula for material price variance is the smaller rectangle which starts with SP, connects with AQ, and subtract the bigger rectangle which starts with AP and connects with AQ. So SP into AQ minus AP into AQ is called as material price variance. The balancing figure is going to become the top part, that green portion which you see, that will become the balancing figure. Similarly, the usage variance is SP into SQ, the smallest rectangle, minus SP into AQ. You will be left with the blue shaded portion. You will be left with the blue shaded portion. There is a blue shaded portion which you see here, and there is a green shaded portion which you are seeing there. So the formula is very simple. You need to write one area and another area. The gap between them should be that blue shaded portion or the green shaded portion. For example, if the first line is this, and then from there if you subtract this, you will be left with that in between area. Or the first line is this portion and the second line is this portion, you will be left with this in between area. So this is called SP, and this was your SQ, and this was your AQ. So SP into SQ minus SP into AQ will give you that green shaded portion in between. Or SP into AQ minus AP into AQ will give you the green shaded, okay, the blue shaded portion is SP into SQ minus SP into AQ. This logic is what is used for the main variance also. This two areas put together, the price and usage put together, is called cost variance. So the smallest rectangle SP into SQ minus the biggest rectangle AP into AQ is that in between portion. The smallest rectangle minus the biggest rectangle. I'll explain again one more time. After that also, if it's not clear, please let me know, because the first time if you don't understand, you'll find it difficult later on, because next time onwards I'll just be doing the same chart again and again. We'll be doing this chart some 10 times. There are 2 scenarios in material variances, 4 scenarios in labor variances, 1 scenario in variable overhead, 2 scenario in fixed overhead, 2 scenario in sales variance. Everywhere the same chart is going to be used. Once you understand one chart, you need not remember any formula in standard costing. Any formula in standard costing is not required to be remembered. You just remember the chart or the logic of the chart, things will automatically fall in place. So I'll do the chart again. Now in order to do the chart, this side you have SQ, AQ, this side you have SP, AP. You connect SP with SQ, you connect SP with AQ, you connect AP with AQ. I don't connect AP with SQ because that's not going to help me in calculating the variances. You can calculate AP into SQ if you want, but that's not going to calculate any variances. No variances will be computed with AP into SQ. So that's why we are not doing. The top part, the gap between SP and AP is called price. The gap between SQ and AQ is called usage. So the formula for usage variances, the smaller rectangle SP into SQ minus the bigger rectangle SP into AQ. The formula for price variance, the smaller rectangle SP into AQ minus AP into AQ. The smaller rectangle is basically starting from here till here and from here till here. The gap is called as the price variance. The gap is called as the price variance. This minus this. Similarly, you will have to do for usage, which is starting from here till here and from here till here. The gap is called as the usage variance, and put together is called as the cost variance. Any doubts on the chart? If you want me to explain one more time, I am ready to do it. But if still people are not clear with the chart, let me know. Anyone has any clarity issues on the chart, please let me know. Clear? Okay, now you can write along with me. First, let's put the chart. Write this side quantity, price, SP, AP, SQ, AQ. Now there is no logic as to why SP comes below AP, AP comes above SP. It can be either ways. The only thing is this will help us in getting to the formula, so that's why we are doing it this way. SP, AP, SQ, AQ. SP into SQ, SP into AQ, AP into AQ. Connect those items. Connect those items and write below. After connecting, write computation table. Connect items like this: SP with SQ, SP with AQ, AP with AQ. I don't remember computation table, I don't remember formula. Somewhere I visualize chart, everything else automatically comes in. The chart will get you to all of this. Computation table, SP into SQ, SP into AQ, AP into AQ, SP into SQ, SP into AQ, AP into AQ. Clear? Any doubts on this? SP into standard quantity, SP into actual quantity, and AP into actual quantity. Material cost variance is equal to, material cost variance is equal to, right in the center, material cost variance is equal to, I will split this into two, standard material cost minus actual material cost. Standard material cost minus actual material cost. Standard material cost minus actual material cost. Standard is SP into SQ, actual is AP into AQ. Standard is SP into SQ, actual is AP into AQ. All this is done at CA Inter, just kind of revising what you did there, because this is an area where many students have found it difficult, so that's why we cover it from the basics. Technically I need not cover the first 5 hours of class. Technically is the first 2 classes on standard costing is technically what you did at CA Inter. Standard material cost minus actual material cost, SP into SQ minus AP into AQ. This gets split into 2. Material price variance material usage variance, material price variance and material usage variance. Material price and material usage, price variance and usage variance. Price variance you can write standard price minus actual price. This is a broader formula, but the actual formula will come to it. This is just a logical formula. Standard price minus actual price is material price variance, but this needs to be multiplied with something, but this is a normal formula for any variance. Similarly, this is standard quantity minus actual quantity, standard quantity minus actual quantity. This is not the right formula. This is not the right formula. Basic thing is price needs to be multiplied with something. The formula is SP minus AP, but you need a multiplier. The formula is SQ minus AQ, but you need a multiplier. So this formula is SP into AQ minus AP into AQ. I am taking this from the chart, okay. Standard price into actual quantity, that chart, minus the AP into AQ. SP into AQ minus AP into AQ. Standard price into actual quantity minus actual price into actual quantity. SP into AQ minus AP into AQ. This side SP into SQ minus SP into AQ. SP into SQ minus SP into AQ. Any doubts on this? The formula comes from the chart. Understand the chart properly. Now listen, you need not write anything beyond this. Listen, technically what has happened is, this is the formula, this was multiplied with AQ in both the places. This was multiplied with actual quantity in both the sides. This was multiplied with actual quantity in both the sides, SP minus AP, and if you multiply with actual quantity, if you write this in bracket and multiply with actual quantity, you get the formula. This was technically multiplied with standard price. This was technically multiplied with standard price. Now listen, when I calculate material price variance, material price variance is the difference between standard price and actual price. The job of the purchase manager is to buy whatever quantity I ask for. The job of the purchase manager is to buy whatever quantity I ask for. So if I am asking more quantity, he has to buy more. If I am asking lesser quantity, he has to buy less. So whatever quantity I ask, he has to buy. So the variance is considered for the quantity which he has bought or quantity which has been used. Technically it's quantity which has been used. There is also variance for quantity which has been purchased, which you will learn later. But technically whatever quantity has been utilized by the production manager, on that quantity this variance is considered, and not on the standard quantity. The variance is considered on the quantity which has been utilized, and the logic is simple. The role of the purchase manager is to buy whatever I ask for. Material usage variance is the difference between standard usage and actual usage. So there is some inefficiency. I wanted to use 100 kg, but I have used 120 kg. So extra 20 kg is wastage. That extra 20 kg will have to be valued at the price which was agreed on initially. So what the production manager is going to say is, you told me to use 100 kg, I have used more. So extra kgs utilization is my problem. But you cannot penalize me for example, I wanted to buy at 4 rupees and he ended up buying at 5 rupees. This extra 1 rupee is not my penalty. That extra 1 rupee you consider it in the price variance. For me the penalty has to be only the originally agreed price, which is the 4 rupees. The originally agreed price should be my penalty. The role of the purchase manager is to buy whatever I ask for. That is why his variances is considered for the actual quantity and not for the standard quantity. He can also argue, why don't you calculate my variance as SP into SQ minus AP into SQ? That doesn't work. For him, the variance will be recognized for the actual quantity because his job is to buy whatever I ask for. This guy is going to say, I underutilized or overutilized, you penalize me, but penalize me at the price which was originally agreed on. Don't penalize me for at a higher price. I originally agreed a price, you penalize me for that price, I am ready to pay that much, but don't penalize me for a higher amount or a lower amount. Clear? Any doubts till now? The formula is going to come from the chart only. The chart will give you the formula. This part is called price, you can write this in the chart, and this part is called quantity. Price and quantity, the together part is technically the cost variance. Material price variance is the top part, material quantity variance is the bottom part. The difference between SQ and AQ, the difference between SP and AP. Any doubts till now? Any doubts? Now write note SP refers to the price. SP refers to the price to be paid, for 1 unit of raw material, price to be paid for 1 unit of raw material, and AP refers to the price actually paid, for 1 unit of raw material. Price to be paid and price actually paid. Standard price is the price to be paid, actual price is the price actually paid for buying 1 unit of raw material, SQ refers to the quantity to be used, for producing actual output, quantity to be used for producing actual output, and AQ refers to the quantity actually used. Quantity to be used and AQ refers to the quantity actually used by the organization. There is something called as quantity purchase. There is a difference between that. I will explain as we proceed. So AQ is the actual quantity. Quantity means raw material. Output means finished product. The term actual output is finished product, and actual quantity means the raw material which has been used by the organization. Now you can write a formula. SQ is equal to, SQ is always calculated with the help of actual output. SQ is equal to actual output into input by output ratio. Actual output into input by output ratio. I will touch upon this as we do a question. Into input by output. Input output ratio will tell you how many units of raw material is needed for producing 1 unit of output. Your standard quantity is always calculated with the help of actual output. Standard quantity is always, the term standards means it's always with the help of actual. Standard cost calculated with the help of actual output. Standard time calculated with the help of actual output. Standard output calculated with the help of actual time. Any standard will always be calculated with the help of something actual. It can be actual output, actual time, actual quantity, but standards are always calculated with the help of actual. You need some actual data to calculate standard. Standard means what should have been the raw material used, what should have been the quantity consumed, what should have been the profit earned. that is to be calculated for the actual capacity utilization. Next, situation 2, multiple raw material. Situation 2, multiple raw material. Situation 2, multiple raw material. Multiple raw material. Okay, now listen for some time. The two parts remain same, SP, AP. This side also remains same, SQ, AQ. When you have multiple raw material, in between an item comes called as RSQ, revised standard quantity, or RAQ, revised actual quantity. Different names can be used. RSQ or RAQ. In between an item comes called as RSQ. Listen for some time. I don't want to write anything. Just listen for some time. I'll give you time to write. SP, AP, SQ, AQ. In between an item comes called as RSQ. The computation table is SP into SQ, SP into RSQ, SP into AQ, AP into AQ. I don't connect with SQ or RSQ AP because I don't need it. So the computation table will have SP into SQ, SP into RSQ, SP into AQ, AP into AQ. The top part is price. This two parts together is called usage. The two parts together is called usage. Usage gets split into two. Usage gets split into two. Something called as material yield variance and material mix variance. I'll explain the logic of the formula in some time. But this part is called yield variance and this part is called mix variance. The formula will come with the same logic, smaller rectangle minus the bigger rectangle. Can you tell logically what is the formula for material mix variance? The logic which I told, SP into RSQ minus SP into AQ. This comparison of these two, SP into RSQ minus SP into AQ. Material yield variance, SP into SQ minus SP into RSQ. Usage variance, SP into SQ, the two areas put together, minus SP into AQ. Material price variance, SP into AQ minus AP into AQ. Material mix variance, SP into RSQ minus SP into AQ. Mix, sorry, yield. Okay, clear? So the chart will take you to the formula. The chart is going to take you to the formula. Why the first part is called yield, the second part is called mix. I'll explain that logic in some time. I'll explain that when I do a problem itself. What is the logic of this yield and mix being there? That part I'll discuss in some time. So here what happens is the main variance is called material cost variance, which is the difference between standard material cost and actual material cost, which is SP into SQ, AP into AQ. This gets split into two, which is your material price variance, material usage variance. You can write the formula for price variance from the chart, usage variance from the chart. This gets split into material yield variance, material mix variance. Yield variance is the difference between standard yield and actual yield. Mix variance is the difference between standard mix and actual mix. That's the base formula. Difference between standard mix and actual mix. Difference between standard yield and actual yield. So the formula is going to come from the chart. So you'll first put the chart, then write the computation table, and then start noting down the formulae. I'll give some notes in some time. Some point of explanation I'll have to do, that I'll explain. So put the chart. Let me know if you have a doubt in the formula interpretation. In case you are not clear on how the formula is arrived, please let me know. first flow. The chart will take you to the formula. I don't remember anything beyond the chart. Chart will give you the computation table as well as the formula. The computation table is SP into SQ, SP into RSQ, SP into AQ, AP into AQ, and then write the formulae. Please start noting down the formula. In case you have a doubt in the formula, I have not written the formula there. In case there is any confusion on the formula, let me know. The formula is going to come from the chart. In case you are not sure about any of the formula, please let me know. Material cost variances SP into SQ minus AP into AQ get split into price and usage. Price is SP into AQ minus AP into AQ. This is SP into AQ this is SP into SQ minus SP into AQ. Yield variance, I am writing the formula from the chart. I will explain the logic for yield and mix when I do a question. SP into RSQ minus SP into AQ. The formula is going to come from the chart. Remember the chart, you will get to the formula. If there are doubts in the chart, then let me know. Clear? Can we proceed? Any doubts? Any doubts on this? Now write note. RSQ is the total of actual quantity. RSQ is the total of actual quantity. Total of actual quantity in standard mix. You can just write this. The explanation to this will flow when I do a question. total of actual quantity in standard mix, total of actual quantity in standard mix. Let's now move to labor variances. Now write labor variances. Labor variances. Totally there will be 4 situations for labor variances. Situation 1, single labor without idle time. You can write along with me itself, single labor without idle time. Single labor without idle time. The 4 situation is single labor, multiple labor, each of them without idle time and with idle time. So single labor without idle time, single labor with idle time, multiple labor without idle time, multiple labor with idle. What is single and multiple? Single is using a single grade of labor, multiple is grade A, grade B, men, women, boys, skilled labor, unskilled labor, semi-skilled labor. So some categorization they can give. The 2 components of your material cost was price and quantity. Here it is rate and hours. So this side you have SR, AR, you can write along with me, SR, AR. This side you have SH, AH, SH and AH, SR, AR, SH, AH. The computation table will have SR into SH, SR into AH, AR into AH. The computation table will have SR into SH, SR into AH, AR into AH. The top part is called rate, the bottom part is called efficiency. There it was called price and usage, here it is called rate and efficiency. Rate and efficiency. Can you look at the chart and tell me the formula for labor rate variance? SR into AH minus AR into AH. SR into AH minus the gap between SR and AR is the rate variance. The gap between SH and AH is the efficiency variance. Labor efficiency variance. SR into, I want participation, SR into SH minus SR into AH. The 2 things put together is called labor cost variance, smallest rectangle minus the biggest one, SR into SH minus AR into AH. Clear? Any doubts on this? Below this, labor cost variance, SR into SH minus AR into AH. The simple formula is standard labor cost minus actual labor cost. Any variance is standard minus actual. SR into SH minus AR into AH. SR into SH minus AR into AH. Split into 2. Labor rate, labor efficiency. Labor rate and labor efficiency. Rate variance and efficiency variance. Rate variance it is SR into AH, AR into AH, SR into AH and AR into AH. Efficiency side, what's the formula? SR into SH SR into SH minus SR into AH. Clear? Any doubts on this? Any doubts on this part? Clear? Can you proceed? Any doubts on the table? Now write note. SR refers to the rate to be paid. SR refers to the rate to be paid per hour. Rate to be paid per hour. Rate to be paid, and AR refers to the rate actually paid per hour. Rate to be paid and AR refers to the rate actually paid per hour. Actually paid per hour. SH refers to the time to be taken, refers to the time to be taken, time to be taken for producing actual output. SH is always calculated with the help of actual output. Standards are always calculated with the help of actual. Refers to the time to be taken for producing actual output, and AH refers to the time actually taken. Time actually taken. Clear? Any doubts on this? This is single labor without idle time. Situation 2, single labor with idle time. Situation 2, single labor with idle time. Single labor with idle time. Okay, now I don't want you to write, listen for some time, I will give you time. What is idle time is, it's basically the time for which salary is paid but no work is done. The employees are paid, wages are paid but work is not done. Idle time is basically the difference between actual hours paid and actual hours worked. Actual hours paid and actual hours worked. There is going to be a gap between these two. The payment could be done for 10,000 hours, but they would have worked only for 9,500 hours. 500 hours is idle time. There is something called as normal idle time and abnormal idle time. Normal idle time is not considered as idle time. That is basically time worked only. For example, your coffee break, lunch break, all that is unavoidable. That is considered as part of hours worked. There is abnormal idle time like power failure, equipment failure, all those will be considered as idle time, for which I had to pay but they were not working. They were not working. Now, this side I have SR, AR, I have SH, AH. AH will be called as AHW, AHP. Actual hours worked, actual hours paid. The computation table will have SR into SH, SR into AHW, SR into AHP, AR into AHP. This part is called rate, efficiency, and this is idle time, the gap between hours worked and hours paid. Idle time will always be adverse. Idle time variance will always be adverse. What is the formula for labor idle time variance? SR into AHW minus SR into AHP. Labor efficiency variance, SR into SH minus SR into AHW. The efficiency is only the first part, okay. It is now the labor cost variance will be split into three: rate, efficiency and idle time. It will be split into three. Your computation table will have SR into SH, SR into AHW, SR into AHP, AR into AHP. SR refers to the rate to be paid, AR refers to the rate actually paid, SH refers to the time to be taken, AHW refers to the hours worked, AHP refers to the hours paid, and idle time is the gap between these two. Idle time is basically the gap between actual hours paid minus actual hours worked. In the formula it's AHW minus AHP because I will get a negative answer, that would mean adverse. If you do AHW minus AHP, you will get a negative answer. Idle time is basically actual hours paid minus actual hours worked when you calculate it. But for the variance purpose, you will have to do AHW minus AHP. Clear? Any doubts on this? Put the chart, computation table, and then write the formula. The main variance is called labor cost, which is split into three now: rate, efficiency and idle time. It will be split into three. This is your chart, computation table, and then the formulae. Let me know if there are doubts with any of this. Clear? Can you proceed? Any doubts in this? Now you can write note: idle time refers to hours paid but not worked. Hence this is the difference between actual hours worked and actual hours paid. Difference between actual hours worked and actual hours paid. Clear? Any doubts on this? Done? Can you proceed? Next, situation 3: multiple labor without idle time. Multiple labor without idle time. You can write along with me. Multiple labor without idle time. This side SR, AR, SR and AR. I have SH, AH, and in between I get RSH. Like we added RSQ, we are adding RSH here because it's multiple labor. Multiple labor, in between you will add RSH. Between SH and AH, we will use RSH in between. Computation table: SR into SH, SR into RSH, SR into AH, AR into AH, SR into SH, SR into RSH, SR into AH, AR into AH. Standard rate into standard hours, standard rate into revised standard hours, standard rate into actual hours, actual rate into actual hours. SR into SH, SR into RSH, SR into AH, and AR into AH. Standard rate into standard hours, standard rate into revised standard hours, standard rate into actual hours, and actual rate into actual hours. The top part is called as rate, together it is called efficiency, together it called efficiency. This is called yield slash sub efficiency, yield or sub efficiency, and this is called mix or gang, mix or gang, mix or gang variance. Can you tell me what's the formula for labor yield variance? SR into SH minus SR into RSH. Labor gang variance, SR into RSH minus SR into AH. Labor efficiency variance, SR into SH minus SR into AH. Labor rate variance, SR into AH minus AR into AH. Write down the formula for the variances. Labor cost split into rate and efficiency. Efficiency is further split into yield and mix. Below the computation table, write the formulae. You please write the full name so that you remember it properly. The logic for the variances and all remains same, so I am not getting into the logic again. The logic for the variances is going to remain same as what we did in material variances. If there is any extra items to be explained, I will explain those alone. Like idle time, I did some explanation, but other variances are same as what we did there, same as whatever we have done there. Any doubts on this? Clear? Labor yield or labor sub efficiency, labor mix or labor gang variance, the other names. Yield or sub efficiency, mix or gang variance. Any doubts on this? Clear? Now write a note. RSH is the total of, RSH is the total of actual hours. RSH is the total of actual hours in standard mix. Total of actual hours in standard mix. Total of actual hours in standard mix. There it was total of actual quantity in standard mix. Here it's called total of actual hours in standard mix. Any doubts on this? Any doubts on the RSH part? Clear? Okay. Now write situation 4. Situation 4. Multiple labor with idle time. Multiple labor with idle time. Multiple labor with idle time. Now listen for some time, you can write it later. Listen for some time, I will explain the chart and the computation table. You can write it in some time. Now this side we will have SR, AR. Here we will have SH, AH. Because it's multiple labor in between RSH, because it's idle time, it is AHW, AHP. Because there is an idle time, it has AHW and AHP. Computation table is SR into SH, SR into RSH, SR into AHW, SR into AHP, AR into AHP. The top part is called rate. This is idle time. This is your yield, mix, and this together, the first two alone is efficiency. The first two alone is efficiency. So the main variance is labor cost variance, that will be split as rate, efficiency and idle time. Efficiency will be further split as yield and mix. What's the formula for labor efficiency variance? SR into SH minus SR into HW. Labor yield variance, SR into SH minus SR into RSH. Labor mix variance, SR into RSH minus SR into AHW. Labor idle time variance, SR into AHW minus SR into AHP. Labor rate variance, SR into AHP minus AR into AHP. It's that simple. Once you know the chart, the formula will automatically flow. Put the chart, computation table, and then write the formula. I just need to give one note after that. So one explanation needs to be given. First put the chart, computation table, and then the formula. Yep. SR into AHW, the first two items. Your efficiency is combination of yield and mix. So you are looking at this and this. Let me know if there are any doubts in any of the variances. Fairly simple, straightforward calculation. If there are doubts in any of the variances, please let me know. There's one item which I need to explain. The chart will get you to the formulae. All the 4 situations, we can remember the formula with the chart. Clear? Can we proceed? Okay, now listen. We've done all of this. What RSH is? It's the total of actual hours in standard mix. The problem here is you have 2 actual hours. There is an actual hours worked and there is an actual hours paid. When you do a multiple labor situation with idle time, there is an actual hours worked as well as actual hours paid. We simply said RSH is the total of actual hours. So I'll have to write this note again. But I need to decide whether it is the total of actual hours worked or actual hours paid. Now listen, your mix variance is calculated by comparing RSH with AHW. By comparing RSH with AHW. So RSH is the total of AHW in standard mix. AHW is the total of AHW in actual mix. AHW is AHW in actual mix and RSH is AHW in standard mix. Actual hours worked in standard mix. So RSH is the total of actual hours worked in standard mix. That's a note you'll have to write. Total of actual hours worked in standard mix. Total of actual hours worked in standard mix. Clear? Any doubts on this? Okay. I'll move to the next category of variances. We did not do all the 4 situations. Single labor is something we'll see in comprehensive set of question. I'll move to the next category, which is your variable overhead variances. When it comes to VOH variances, we don't have multiple situations. There's only one situation. At inter level, you would have learnt about something called as overhead absorption rate. That is basically the rate at which you absorb overheads in a product. For OAR computation, for your overhead absorption rate computation, the numerator used to be budgeted overheads. The denominator was a suitable base. The base can be, some organization will recover overheads on the basis of raw material quantity, some organization on the basis of labor hours, some organization on the basis of machine hours, some organization on the basis of output produced. So the denominator, the base can be different for different companies. The OAR can be different for different companies. 90% of our problems, be it in your, when you would have done overheads chapter or even in standard costing, the base which we use is labor hours. We use a base of labor hours to do the calculation. But some question, instead of labor hours being the base, there's one problem where the base will be kilowatt hours. Kilowatt hours is the number of units of electricity consumed. One problem, I think you will see the base to be output produced. So the base can change, but the normal suitable base which we use, normally the overhead absorption rate is calculated on the basis of labor hours. So what we do here is, you can write it in a minute, SR, AR, SH, AH. Your overheads are recovered on the basis of hours. For example, in some question it's not hours and in some question it's kilowatt hours. Then you can say SKWH, AKWH, standard kilowatt hours, actual kilowatt hours. The formula can change that way. Some question it's not kilowatt hours and it is number of receipts. Standard receipts, actual receipts. You will anyway learn about this when I go to activity based costing and standard costing linkage. But the base can change. The base can change. We normally use the base as number of hours. If you use the base as number of hours, you will use SH and AH in the computation table, but it can become kilowatt hours, it can become number of receipts, it can become machine hours, it can become inspection hours. If it's inspection hours, you will say SIH, AIH, standard inspection hours, actual inspection hours. So my computation table will have SR into SH, SR into AH, AR into AH. This part is called expenditure variance and this part is called efficiency variance. So we have two variances, variable overhead expenditure variance, variable overhead efficiency variance, and the overall variance is called variable overhead cost variance. The overall variance is called VOH cost variance. What is the formula for VOH expenditure variance? SR into AH minus AR into AH. VOH efficiency variance, SR into SH minus SR into AH. So now write variable overhead variances, variable overhead variances, variable overhead variances. You can start doing the chart along with me now. SR AR, SR AR, SH AH, SR AR, SH AH, standard rate into standard hours, actual hours, and actual rate into actual hours. That is what will go in the computation table. SR into SH, SR into AH, AR into AH, standard rate into standard hours, standard rate into actual hours, actual rate into actual hours. The top part is called expenditure variance and this is called efficiency variance. SR into SH, SR into AH, AR into AH. The top part is called expenditure, the bottom part is called efficiency, expenditure variance and efficiency variance. Expenditure and efficiency. Below this table I want you to leave a gap of some 3-4 lines. I need to write something there. Below that you can start writing the formula. Variable overhead cost variance is equal to, variable overhead cost variance is equal to SR into SH, smallest rectangle minus the biggest one, AR into AH, SR into SH minus AR into AH, VOH cost variance, VOH expenditure variance. Expenditure is basically the difference between standard expenditure and actual expenditure, which is computed with the help of rate. SR into AH minus AR into AH, standard rate into actual hours minus actual rate into actual hours. Expenditure variance and efficiency variance. Efficiency is SR into SH minus SR into AH, standard rate into standard hours minus standard rate into actual hours. Any doubts on this? Clear? Now few questions we will not have the data itself in the problem to calculate standard hours, or few questions the actual hours may not be available. So there are few questions where sometimes you will find it difficult to calculate standard hours or data itself will not be there to calculate standard hours. This SR into SH can also be called as SR into AO. Why it is called AO is actual output always influences the standard time. Standard time is always calculated with the help of actual output. So SR into SH is otherwise called as SR into AO. Similarly, SR into AH is otherwise called as SR into SO. SO is standard output. Standard time and actual output is interlinked. Similarly, actual time and standard output is interlinked. Any standards is always calculated with the help of actual output. So if you want to calculate standard output, that will be calculated with the help of actual time. Standard output will be calculated with the help of actual time. AR into AH is nothing but actual variable over it. Actual variable over it. When you multiply both, that is, even in the other areas, AP into AQ is actual material cost, AR into AH is actual labor cost. So here it is actual variable over it. AR into AH is actual variable over it. Write this. SR into SH is otherwise called as SR into AO. There is some extra explanation on this in some time. SR into AH is otherwise called as SR into SO, and AR into AH is otherwise called as AVOH. Any doubts on this? Now let's first understand what is the standard rate. Come down, note. There are two types of standard rate you will calculate. Standard rate per unit. Standard rate per unit is equal to budgeted variable overhead by budgeted units. This is the formula for your OAR computation. Budgeted variable overhead by budgeted units. SR per unit is equal to budgeted variable overhead by budgeted units. SR per R is equal to budgeted variable overhead by budgeted Rs. You will divide by budgeted Rs or budgeted units. That will give you the standard rate. Standard rate will be very not tricky, but that is an area which will not be directly available. Till now SR used to be directly available, be it your material variances or labor variances. Here the standard rate is a calculation needs to be done. There are two types of standard rates. One is called standard rate per unit, another one is called standard rate per hour. Now what is the use of these two numbers is, if you are using AO or SO in the calculation, that is your column 1 can be SR into SH or can be SR into AO. The first problem I will do both, but it can be one of the two. When it's one of the two, if you are using actual output, with that you will have to multiply with standard rate per unit. With that the multiplier is standard rate per unit, because you are multiplying with actual output. Output can be multiplied with rate per unit. If you are using standard output, again you will multiply with rate per unit. But if you are using standard hours or actual hours, you will multiply with standard rate per hour. Both will give the same answer. Few question you will use SR into SH, few question you will use SR into AO, few question only one of them will be possible. Few problems only one of them will be possible. If only one of them is possible, you will have to follow that. You don't have a choice to try to do the other one, because data will not be there. For example, if I want to calculate standard time, I want to know for calculating standard time, what is the relationship between the output and the number of hours. There should be some data in the question. You will see a problem where this information is not given. If they have not given that information, then you cannot do much. So SR into SH can otherwise be called as SR into AO, and it is SR per hour into standard hours is equal to SR per unit into actual output. Both the SR is not same, they are different. In one place you use standard rate per hour, in another place you will use standard rate per unit. Clear? Any doubts on this? And your SH and AH calculation is same as what you do in your labor chapter or the labor part of the calculation. Now only one more point. It is normally assumed that it is normally assumed that variable overhead will not be incurred. Variable overhead will not be incurred during idle time. Variable overhead will not be incurred during idle time. Hence AH for VOH variances, actual hours for VOH variances, will be equal to AHW. Actual hours for VOH variances will be equal to AHW. This is a normal understanding. Your variable overheads are incurred when the factory is working. Your variable overheads are normally incurred when the factory is working. When the machinery is working, you incur some electricity cost or the power cost. So your variable overheads are normally incurred when the factory is working. There is one area called as idle time, where the factory is operational but it's not able to do the production because of multiple issues, but you are paying the laborers. So there was a gap between AHW and AHP. Here also technically, if you are incurring variable overheads even during, we have not seen any problems like this being tested in exam, but in a practical scenario, if we are going to incur variable overheads even during idle time, then I can technically split this chart as AHW, AHP, this is efficiency and this is idle time. The next part will be idle time and this expenditure will go to the last part. The expenditure will get extended to the last part. If at all idle time is there, I have not seen a problem like that even getting tested till now in exam or in your study material being discussed, because normal assumption is in variable overheads, if there is any idle time scenario in the problem, during that idle time variable overheads will not be incurred. So this AH is technically AHW. There is no concept of AHP. Or in short, there is no difference between AHW and AHP as far as variable overhead is concerned. I don't have any distinction between both. Clear? Any doubts on this? Okay, let's now continue with fixed overhead variances. We are done with the variances as far as your variable overhead is concerned. We will move to now fixed overhead variances. When it comes to fixed overhead variances, it's going to be slightly different from, guys please listen, it's going to be slightly different from all other category of variances. The major reason for this is your fixed overheads do not change with volume, whereas all other expenses will undergo a change with volume. For example, when I was calculating my material variances, I am not bothered if there is a difference between the budgeted output and the actual output. If the budgeted output was 10 lakh unit and the actual output is 9 lakh unit, we were least bothered about it because we calculated standard quantity compared with the actual quantity. We never were bothered about if there is a difference between the output which you wanted and the output which you got. Same is with the labor variances, same is with variable overhead variances, because that difference will be auto considered in our calculation, because automatically the values come down. If output comes down, automatically the cost comes down. If output goes up, automatically the cost goes up. The problem is with fixed overheads, where what happens is SR, which is determined at the beginning of the year or at the beginning of the month, the standard rate, which is budgeted fixed overhead by budgeted output. Budgeted fixed overhead, I am calculating SR per unit, okay. Budgeted fixed overhead by budgeted output, and the AR, which is determined at the end of the year, actual fixed overhead by actual output. Actual fixed overhead by actual output. So your plan was to spend 10 lakh and produce 1 lakh unit. Now other categories, I am not bothered about the denominator part. I am really not bothered about the denominator part, because there, if it was 10 rupees per unit, if output changes, automatically the cost will undergo a change. But in fixed overheads, what is going to happen is, I want this 10 lakh to be same 10 lakh. I don't want this to fall. So increase or come down. Let's assume this goes up to 11 lakh. And unfortunately, this 1 lakh comes down to 80,000. This 1 lakh comes down to 80,000. Your cost would be some 14 rupees type. some 14 rupees. So there's going to be a huge under absorption, there's going to be a huge under recovery and huge adverse variance for the company. So here I want the numerator also to remain same and the denominator also to remain same. In all other category, when I initially gave you an example, I said the budgeted cost was 20 lakh rupees, 1 lakh units were to be produced, company produced less, the production manager came and asked for bonus. We said that bonus is not possible because you should have cut down the cost, because you have cut down the volume. But fixed overheads, that logic does not work, because you are cutting down the output will not help. So for example, if during COVID times there is a decrease in the output, you will see the fixed overheads per unit increasing significantly. The FOH per unit would have gone up significantly, and at some point of time organization will say it is not sustainable for us to continue operation, because if your operations continue to be very low, your fixed overheads, for example, in this class there are 50 students. Now if the students come down to 10, I cannot go back to the student and say that our fixed overheads remain same. So if I calculate per student, it is coming out to be some 15,000 rupees. So would you pay a fees of 20-25,000? No student is going to pay that. So technically, because your output is less, you cannot go back to the customers and tell them to pay a higher price. So one, it is extremely critical that I estimate this fixed overheads properly and ensure both the numerator and the denominator remain same. So in all other variances we calculated, we had a material variance. The cost was split as price and usage. Usage is basically the comparison of standard quantity and actual quantity. Then we did labor variances, which was split into rate and efficiency. Efficiency is the comparison of standard hours and actual hours. Then we did your variable overhead variances, again the comparison of standard hours. Fixed overhead variances, the breakup will be expenditure, which is the difference between the two numerator, budgeted expenditure and actual expenditure, and the denominator, which is called volume variance. For fixed overheads you don't have efficiency. Efficiency is one subpart of volume. Efficiency is one subpart of volume. So the denominator variation, the budgeted output and actual output variation is called as volume variance, and that is very critical that I don't see any changes there. When I do fixed overheads, there are two types of question. One type of question is with calendar variance, and second type of question is without calendar variance. What is this with calendar, without calendar? You will understand as we proceed. Now write fixed overhead variances situation 1. Fixed overhead variances situation 1. Situation 1. FOH variances without calendar. FOH variances without calendar variance. FOH variances without calendar variance. Now technically I don't have a chart which can help me in FOH variances, but still I created a chart. It is going to be slightly different from the normal charts which you see. The normal chart was very simple, SR, SH, so it was like that. Here what will happen is, I will have SR, but the second item is not AR. I will not have a second item called as AR. What is going to come, you will understand in some time. This side you will have SH. This side you will have, just give me a minute. You will have AH, standard hours, actual hours, and also have another item called as BH. What is BH? Is budgeted hours. BH is budgeted hours. We were least bothered about this term called as budgeted hours till now. In none of the variances I was bothered about budgeted hours or budgeted quantity, because those two numbers were not impacting the calculation. So this is one variance where even the budgets will be critical. So SR into SH is my first thing, SR into AH is my second thing, and SR into BH is my third thing. The outer part is AFOH. I don't want to use the word AR because AR into AH is called actual fixed overhead, but I don't want to link from here to here. That will not help me in getting the variance formula. The chart is just a tool to remember the formula. So the outer part is called AFOH. I don't want to split it as AR into AH because there is an item AH which is already there in the formula. This outer part is called expenditure variance. The outer part is called expenditure variance. Can you tell me what is the formula for expenditure variance now, looking at the chart? SR into BH minus AFOH, which is nothing but SR into BH minus AFOH is nothing but budgeted fixed overheads minus actual fixed overhead. Budgeted fixed overhead. SR into BH is budgeted fixed overhead. I'll give you time to write the formula and listen for some time now. Expenditure variance is the outer part. So SR into BH minus AFOH is the expenditure variance formula. This together is called volume. This together is called volume. So volume variance, the formula is what? SR into SH minus SR into BH. SR into SH minus SR into BH. This can otherwise be called as SR into AO, SR into BO. This is basically the difference in your denominator, actual output and budgeted output. I said the formula is your numerator and denominator has to remain same. Numerator is BFOH by budgeted output. So the first calculation SR is BFOH by BO and AR was AFOH by AO. If there is any difference in this is called expenditure variance, and if there is any difference in this is called your volume variance. The only change here is it's actual minus budget. It's not budget minus actual, because the logic is simple. If my output goes up, it will be better for the company. See, the variance formula comes in such a manner that you get a negative answer, it should turn out to be adverse variance. You get a positive answer, it should turn out to be favorable variance. If my actual output is more than budgeted output, it's a favorable scenario. It's a favorable scenario. And if your actual output is less than budgeted output, it's an adverse scenario as far as fixed overheads is concerned. Because under fixed overheads, what will happen is, if this AO goes up, indirectly your cost per unit will come down. If AO goes up, indirectly cost per unit will come down and the company will save money. So here the formula becomes actual minus budget. I said in few places it will become actual minus budget. Even when we did variable overhead variances, for example, we did variable overhead variances here. The formula for your first one, efficiency, is SR into AO minus SR into SO. I could have told efficiency variances SR into actual output minus SR into standard output, because if my actual output is more than standard output, it's a favorable scenario. If actual output is more than standard output, it is a favorable scenario. So the logical formula is, if you want to maximize few items, for example, I want to maximize output, I want to maximize sales, I want to maximize profit. If you want to maximize few things, for that the formula will be actual minus standard or actual minus budget. And for items which you want to minimize, like quantity used, like your price which you pay, like the material cost, like the labor cost, wherever you want to minimize something, the formula becomes standard minus actual. But few places it can become actual minus standard or actual minus budget. A classic example is your sales variances. There the formula will become actual minus budget and not standard minus actual. So the second part was the first part is called expenditure variance, the second part is called volume variance. Expenditure variance is the difference in your numerator, volume variance is the difference in your denominator. Now why did volume come down? Two reasons: efficiency, capacity. All other variances, volume variance means efficiency variance. Till now all variances you did, when you did material variances, we said material usage, that material usage is nothing but material quantity or the efficiency part of it. The difference between standard quantity and actual quantity is the efficiency of usage. When you did labor variances, efficiency is difference between standard hours and actual hours. So if there is any variation in the output produced, till now all approaches were thinking variation will happen only because of efficiency. Efficiency variance is the same formula. What is the formula for efficiency variance? SR into SH minus SR into AH. My actual hours is 10,000, just an example. Budgeted hours is 11,000. This is a headache. This means I have underutilized capacity. I am not talking about the overall capacity, I am talking with the planned capacity. We had a planned capacity saying that we will work for 11,000 hours. You have worked only for 10,000 hours. This is a problem. This is a problem statement. If you are not working for full hours, this is a problem for the company. Any underutilization of capacity will lead to lower volume, will lead to increase in cost per unit, That cost per unit cannot be recovered from the customer. You cannot go back to the customer because you would have sold these units and all. The variances are calculated by the end of the year or end of the month. By this time you would have already sold the units, and some industry it's not possible to increase the price. Just because COVID has come, during that time volumes were less, organizations cannot increase say that I want to increase price per unit because my fixed overheads per unit is on the higher side, so that flexibility will not be there. So when it comes to your fixed overhead variances, I have SR into SH, I will give you time to write, SR into AH, SR into BH, and the last part is called AFOH. I don't want to call it as AR into AH. The main variance is called FOH cost variance, which is the smallest number, SR into SH, minus the biggest number, which is AFOH. Then you have volume and expenditure. Expenditure is SR into BH minus AFOH, and volume is SR into SH minus SR into BH. SH is a representative of actual output, BH is a representative of budgeted output. Difference in numerator, difference in denominator. Then your volume got split into efficiency and capacity. Efficiency, same formula, we have been using this in labor variance, in variable overhead variance, SR into SH minus SR into AH, and capacity is the difference between SR into AH and SR into BH. Let's now start writing this, write along with me. This side write SR, SR, this side SH, AH, BH. Standard hours, actual hours, budgeted hours. So SR into SH, SR into AH, SR into BH, and the outer part is AFOH. The outer part is called actual fixed overhead. The outer part is called actual fixed overhead. This part is called expenditure variance. Expenditure variance together is called volume, efficiency, capacity. The logic of the formula is explained. In case you have a doubt with any of the logic, let me know. Volume split as efficiency and capacity. Efficiency and capacity. Now before you write the formula, we'll have to write the computation table. There are a lot of conversion factors. SR into SH is otherwise called as SR into AO. SR into SH is otherwise called as SR into AO. SR into AH is otherwise called as SR into SO, standard output. SR into AH is otherwise called as SR into SO, standard output. SR into BH is otherwise called as SR into BO, budgeted output, or BFOH, budgeted fixed overhead. SR into BH is otherwise called as SR into BO or BFOH. I may use one of the three in the question, whichever is available I will use that. And the last column is AFOH. Last column is AFOH, actual fixed overhead. Now write the formula for the variances. FOH cost variance is equal to cost variance is equal to SR into SH minus AFOH. SR into SH minus AFOH. You can technically write the formula from the chart. FOH expenditure variance. Expenditure variance. SR into BH minus AFOH. Technically it's BFOH minus AFOH, budgeted fixed overhead minus actual fixed overhead. Budgeted fixed overhead minus actual fixed overhead. FOH expenditure variance. Volume variance. FOH volume variance. Write the formula from the chart itself. Volume variance the variation in volume can be because of two reasons. The variation in volume can be because of two reasons. One is capacity and second is efficiency. There is another reason called as calendar, which I will come in the next situation. Efficiency variance, SR into SH minus SR into AH, efficiency SH minus AH, and capacity variance, which is the difference between actual time utilized as a percentage of or compared with the budgeted time utilization. Actual utilization with the budgeted utilization. Any doubts on this? Note SR per unit is equal to budgeted fixed overheads by budgeted units. Same formula, there it was budgeted variable overhead, here it is budgeted fixed overhead. Budgeted fixed overhead by budgeted units. SR per unit is BFOH by budgeted units. SR per hour is BFOH by budgeted hours. BFOH by budgeted hours. Any doubts on this? Clear? Next, FOH variances with calendar. Situation 2, FOH variances with calendar. FOH variances with calendar. Okay, now listen. What is this calendar variance? Let me first explain that. What is calendar variances? In case there is a difference between the actual days worked and the budgeted days. The question will give both information. A company wanted to work for 20 days a month, but it worked only for 19 days or 21 days. When there is a variation in the days worked, it will lead to calendar variance. Now, why does this come? Now, under fixed overheads, the headache is if you work for more number of days or lesser number of days, the fixed overheads is expected to remain same. So, in case you work for more days, you will be able to produce more unit. Volume variance will be favorable. It will have a final effect on volume variance, which will be a favorable impact. So, the volume can be now because of three reasons. One is efficiency of employee, second is capacity, and the third is actual days compared with the budgeted days. And if you work for more days, it is better. Actual days, if higher than budgeted days, will lead to a favorable calendar variance. It will lead to a, but I need both information. I need actual days and budgeted days. Some question actual days will be there, budgeted days will not be there. Some question budgeted days will be there, actual days will not be there. Unless you have both data, you cannot calculate the calendar variance. So here what will happen is SR, SH, AH, BH, and in between an item will come called as PH. What is PH? Is possible hours. PH is technically called possible hours. What is this possible hours? Is if you are planning to work for 20 days and 2000 hours, your plan was to work for 20 days and work for 2000 hours. If you work for 21 days, possible hours is 2100. Possible hours is 2100, because now it is possible to work for 2100, or you can technically call this as revised budgeted hours. This is like your revision in the budgeted hours, because you work for more days or you work for lesser days. You can go both ways. If you work for more days or if you work for less days, there can be a revision in the budgeted hours. So this is SR into SH, SR into AH, SR into PH, SR into BH, SR into SH, SR into AH, SR into possible Rs and SR into budgeted Rs, and the outer part is called AFOH. This is called expenditure variance, together is called volume. First part is efficiency, capacity, calendar. Now there is a formula difference in capacity variance. There if you look at the formula for capacity variance would have been SR into actual hours minus SR into budgeted hours. Here what is the formula for capacity variance? SR into actual hours minus SR into possible hours. It is possible hours, because now see, your original plan was to work for 20 days and 2000 hours. Now if you work for 21 days, my capacity utilization have to be compared with 2100. Capacity utilization needs to be compared with 2100. So actual hours will be compared with possible hours for capacity utilization, and the gap between possible and budgeted is calendar. Even in the last approach the formula was actual minus possible only, but there is no difference between budgeted and possible. There was no gap between. For example, here also I can say BH or PH, both are same. Budgeted hours or possible hours, technically both are same, because the question will not give data on the actual days and budgeted days. So technically there is no calendar variance. So here your computation table will have SR into SH, otherwise called as SR into AO, SR into H, otherwise called as SR into SO, SR into PH or SR into PO or PFOH, possible fixed overhead, SR into BH or SR into BO or budgeted fixed overhead, and then actual fixed overhead. Put the chart, computation table and then the formula. SR into SH, AH, PH, BH, and then last column is AFOH. The main variance is called cost, split into expenditure and volume. Volume gets split into efficiency, capacity and calendar. expenditure and volume. Volume will be split as efficiency, capacity and calendar. Let me know if there are any doubts here. Done. Write the formula and complete it. Okay. I hope this is done. Write the formula as well. I'll have to give few notes. Okay, now write note. PFOH, possible fixed overhead. PFOH will be computed by taking actual days, we should compute standard cost per day and multiply with standard cost per day and multiply with actual days to get PFOH. You will anyway understand this in a problem. Standard cost per day and multiply with actual days to get PFOH, possible fixed overhead. PFOH is possible fixed overhead. The sales variance part. Now, like material variances, you had single material, multiple material. Sales variances are also of two categories. Now, write situation 1. Sales variances, situation 1. Sales variances, situation 1. Single FG. Single FG, single finished product. There you had single raw material, multiple raw material. For sales variances, you can have a single FG or multiple FG, that the company may be producing a single product or they may be producing multiple products. Now listen. This side you have BP, AP. BP means budgeted price. BQ, AQ. The table is BP into BQ, BP into AQ. Listen for some time. Let me explain few aspects and then you can start doing it. BP, AP, BQ, AQ. There is no difference between budgeted price or standard price, because anything which you calculate at a per unit level, both are technically same. For example, when I gave an example saying 10,000 units 10 lakh rupee, this is the budgeted cost. If you have produced 8,000 units, 8 lakh rupees is the standard cost. This at a per unit level will remain same, 10 lakh divided by 10,000 or 8 lakh divided by 8,000. So at a per unit level there is no difference between the term budget and standard, both are technically same. The difference comes where you calculate the overall budgeted quantity or overall budgeted cost, because budgeted cost is computed based on the budgeted output, standard cost is computed based on the actual output. So technically I don't have any difference between BP and AP. So budgeted price and actual price, and then you have budgeted quantity and actual quantity. Now what is budgeted quantity? Is the units which you are planning to sell. The units which you were planning to sell is called BQ. The units which you have actually sold is called AQ. AQ in sales variances mean actual output sold. AQ in material variances mean actual quantity of raw material consumed. So you have BQ and AQ. Budgeted quantity represents the units which you were planning to sell. AQ represents the units which you have actually sold. Now when I come to sales variances, I cannot calculate something called a standard quantity. What is standard quantity? Standards are always computed based on the actual. What is actual is this here. For sales variances, this is actual. Based on the actual units sold, you cannot tell what should be the budgeted units sold, because technically then both will become same. Whereas your standard quantity, standard time, all that were calculated with the help of actual production by the company, or the actual output produced or actual output sold. Here I don't have a concept called as standards. For sales variances, you cannot compute something called as standard quantity or standard time. So there is no concept like standards which can come here. So we have budgets. Budgeted price into budgeted quantity is called budgeted sales. Actual price into actual quantity is called actual sales. The gap between this is the sales variance. The gap between this is the sales variance. So I do not have a concept called as standards. Budgeted price, actual price, budgeted quantity, actual quantity, BP into BQ, BP into AQ, AP into AQ. This part is called price variance. This is called volume variance. So the name is sales price variance, that's the terminology. Sales price variance is equal to BP into AQ minus AP into AQ. Sales volume variance, BP into BQ minus BP into AQ. Total sales variance, total sales variance is the smallest rectangle minus the biggest rectangle. I'll give you time to write now, listen. Let's assume my budgeted sales is 10 lakh. What is budgeted sales is BP into BQ. Budgeted sales is 10 lakh, BP into BQ is 10 lakh. Actual sales 12 lakh. If I apply the variance formula, which is smallest rectangle minus the biggest rectangle, BP into BQ minus AP into AQ, the answer is 10 lakh minus 12 lakh, negative 2 lakh. Negative 2 lakh. That's what the formula will say. Budgeted sales minus actual sales, BP into BQ minus AP into AQ. If you end up doing this, you will get the answer as negative 2 lakh rupees. Now the answer is negative 2 lakh. Now let me know, is it a favorable scenario or an adverse scenario? Your budget is 10 lakh, you have sold 12 lakh. Is it a good thing or a bad thing for the company? Favorable or adverse? This is a favorable situation. You wanted to sell goods worth 10 lakh, you have sold goods worth 12 lakh. So this is a favorable situation. This is a favorable situation, but the formula is giving a negative answer. Now you have two choices. You apply the formula as what we have been doing earlier, standard minus actual. Here you do budget minus actual. If you get a negative answer, it's a favorable variance. If you get a positive answer, it is a adverse variance. Or if you are comfortable, the formula is the bigger rectangle minus the smaller rectangle. The formula will undergo a change now. There the formula used to be budget minus actual. Here the bigger rectangle. So here the formula is AP into AQ minus BP into AQ, or BP into AQ minus BP into BQ. One, you can interchange the formula or apply the formula as I have been telling earlier, and in the end what you can do is, if you get a positive answer, it's an adverse variance. If you get a negative answer, it's a favorable variance, whatever way you are comfortable. I've seen ICA awarding marks for both, so it doesn't really matter there. But if you are comfortable, you can use the logical formula, which is your actual minus budget. The logical formula is actual minus budget. In my material, everywhere I would have done budget minus actual, but if you are comfortable, you can use actual minus budget. That is the bigger rectangle minus the smaller rectangle. And if you get a positive answer, or if you do the normal way, positive answer is adverse, negative answer is favorable. If you can interchange the formula and do, then whatever we have been doing, positive answer would indicate favorable variance, negative answer would indicate adverse variance. So whatever way you are comfortable, let's first now write situation 1, single FG, this side BP, AP, BQ, AQ, BP, AP, BQ, AQ, budgeted quantity, actual quantity, BP into BQ, BP into AQ, AP into AQ. BP into BQ, budgeted price into budgeted quantity, budgeted quantity, budgeted price into actual quantity, actual price into actual quantity. This part is called price, this is called volume. The variation in the BQ and AQ is called volume variance. The variation between the budgeted output and the actual output is called as volume variance. Price and volume, total sales variance, total sales variance is equal to, I am giving the formula smaller rectangle minus the bigger rectangle, which I normally do, but if you want to interchange the formula, that is also technically fine. If you interchange, positive answer is favorable, negative answer is adverse. If you don't interchange the formula and follow what we have been doing from the beginning, then technically what happens is, if you get a positive answer, it would indicate an adverse variance, and if you get a negative answer, it indicate a favorable variance. So total sales variance is BP into BQ, AP into AQ. Total sales variance BP into BQ, AP into AQ, split into 2. Sales price sales volume, sales price and sales volume, BP into AQ, AP into AQ, budgeted price into budgeted quantity minus budgeted price into actual quantity. That's your sales volume variance. Sales price and sales volume. Clear? Now write note. Note. BP represents the price at which finished product is to be sold. Represents the price at which finished product is to be sold. price at which finished product is to be sold, and AP represent the price at which finished product is actually sold. Product to be sold and actually sold. BQ represents the quantity of finished product, quantity of finished product. BQ is finished product, quantity of finished product budgeted to be sold, and AQ represents the quantity actually sold. Quantity actually sold. Positive answer would indicate adverse variance. Positive answer would indicate adverse variance, and negative answer would indicate favorable variance, in case of sales variances. Positive is an adverse variance, negative is a favorable variance. Positive is adverse, negative is favorable. Clear? Any doubts on this? Okay, next, situation 2, multiple FG. Multiple FG. BP, AP, BQ, AQ. In between an item will come called as RBQ, revised budgeted quantity. Like RSQ gets added, here RBQ gets added. BP into BQ, BP into RBQ, BP into AQ, AP into AQ. This is called price. This together is volume. First one is called quantity, second one is called mix. The first one is quantity, second one is mix. You can complete the chart, computation table, and then note the formulae. The computation table will have BP into BQ, BP into RBQ, BP into AQ, AP into AQ. The main variance is called total sales variance, split into sales price and sales volume. Volume gets split as quantity and mix. Total sales split as sales price, sales volume. Volume gets split as quantity and mix. What's the formula for sales quantity variance? BP into BQ minus BP into RBQ. Sales mix variance, BP into RBQ minus BP into AQ. Sales volume variance, BP into BQ minus BP into AQ. Sales price variance, BP into AQ minus AP into AQ. Clear? Any doubts in this? Now write, note, RBQ is the total of actual quantity. RBQ is the total of actual quantity in budgeted mix. Total of actual quantity in budgeted mix. Actual quantity in budgeted mix. Okay, let's see this in a problem. What we have technically done now is called as total approach. I'll be explaining something called as margin approach and why that approach is needed. You'll understand. Let's come to question 15. A company sold 8,000 units of A and 10,000 units of B at 12 and 16 per unit respectively, against a budgeted sale of 6,000 of A and 9,000 of B. Standard cost and actual cost are as under. Standard variable cost and actual variable cost is given. Compute sales variances under all approaches. I'll explain what are the different approaches. First go through the question. Okay, is this a single FG scenario or multiple FG scenario? Multiple FG. There are talks of product A and product B. Let's put the chart being the first question. Let's put the chart first. BP, AP, BQ, AQ. In between an item will come called as RBQ. BP into BQ, BP into RBQ, BP into AQ, AP into AQ. Price, volume. The logic for the variances remains same. Your mix is the difference between budgeted mix and actual mix. Quantity is the difference between the budgeted quantity and the revised budgeted quantity. So the logic, whatever I had explained earlier, the same logic will work as far as the variances are concerned. Let's open the computation table. Working note 1, sales variances under total approach. The other approaches I'll explain in some time. Sales variances under total approach. Product, BP into BQ, BP into RBQ, BP into AQ, AP into AQ. Product BP into BQ, BP into RBQ, BP into AQ and AP into AQ. What are the two products given in the question? AB. What is the price at which you wanted to sell the product? Sorry? 14 and 13. Price at which you wanted to sell. As far as sales variance is concerned, most of the data will be directly available. There is no calculation to be done except for RBQ. Even your BQ, AQ, everything would be readily available. Normally what we do is standard quantity we have to calculate when you do other variances. Here there is no concept of standard quantity, it is only the budget. 14, 13, what is the actual price? 12 and 16. 12 and 16. How many units are actually sold? 8,000 and 10,000. 8,000 and 10,000. What is the budgeted quantity to be sold? 6,000 and. So for RBQ, what I will do is I will put a total of AQ and split in the ratio of 2:3. That is the budgeted mix. 6,000 is to 9,000, which is a mix of 2:3. The budgeted mix is 2:3. 6,000 is to 9,000. Now come down, note 1. Computation of RBQ. Computation of RBQ. Total of actual quantity. Total of actual quantity. $8,000 plus $10,000. Total of actual quantity 8 plus 10, 18. This needs to be split in the ratio of budgeted quantity, which is 6,000 is to 9,000. It needs to be split in the ratio of 6,000 is to 9,000. RBQ of product A, 18,000 into 2 by 5. Product B, two is to 3. 7,200 is to 10,800. 7,200 is to 10,800. RBQ of A and RBQ of B. 7,200 is to 10,800, split in the ratio of 2 is to 3. Any doubts on this? The computation table is over. Variance calculation is more of a formality. The main variance is called total sales variance, BP into BQ minus AP into AQ. Let me know in case you need any explanation. Beyond this, it's more of a formality. Sales price variance, let me know if there are any doubts on any of the variances. I hope this is done. Okay, now listen. We had a budgeted sales of 2,01,000. Our actual sales is 2,56,000. When it goes to other variances, we did material variances, we did labor variances. Whatever is the variance will exactly impact the profit also. If the variance is 1 lakh rupee favorable, profit will go up by 1 lakh rupee. If the variance is 1 lakh negative, profit will come down by 1 lakh rupee. Whatever is the variance amount, it will directly impact the profits of the company. Now the problem with sales variances, for example, you had originally said sales will be 2,01,000. Profit is going to be, let's assume 20,000 for this. If sales is 2,56,000, profit will not go up by 55,000 rupees. Profit, assuming cost side everything is taken care of. I am not bringing the cost angle. Assuming cost side all issues are sorted out, profit would not go up by 55,000. The reason for that is, what was the original budgeted quantity to be sold together, A and B together? How many units were to be sold? How many units have been sold, A and B together? 18,000. So what happens in sales variances is, this variation is 55,000, but this 55,000 favorable will also lead to some extra cost for the company. It is going to lead to some extra cost for the company, and that is natural because you have sold more units. You have sold more units, there is going to be extra cost. So whatever variances you have done will not help you in reconciling profit, will not help you in reconciling the profit, because the variation in sales is not equal to variation in profit. Whereas if you look at this item alone, the sales price variance, which is 14,000 favorable, this will directly impact the profit. This will directly impact the profit. Why will this directly impact the profit? Is any increase in sales due to higher price will be equal to increase in profit due to higher price. If you increase the selling price by 1 rupee, profit will also increase by 1 rupee. If you increase the sales by 1 lakh units, which is worth 10 lakh rupee, profit will not go up by 10 lakh rupees. So increase in volume will not lead to exact increase in profit, but increase in price will lead to. So the sales price variance which you have, I am going to do 2 more approaches to calculate sales price variance. In both the approaches, sales price variance will be 14,000 only. In both the approaches, I am going to do 2 more approaches. In those 2 approaches, the sales price variance will be same 14,000. It's going to be same 14,000. Next, right? Approach to margin approach, absorption costing, margin approach, absorption costing. Margin approach, absorption costing. Now what is margin approaches? The impact on profit will be understood using the margin approach. If you use the total approach and try to reconcile the profits, it's not going to work. So margin approach is going to help you in reconciling the profit. Whatever extra volume you sold, we have sold an extra volume of I think some 41,000 rupees. This 41,000 will increase profit by some 10,000 or 15,000. It will be some 10,000, 15,000, 20,000, whatever number, will do that calculation, but it is not going to increase profit by 41,000 rupees, because extra volume will lead to extra cost, and all your variances till now has been the difference between standard cost and actual cost. What will happen is, if you sell extra units, the standard cost would have gone up or the standard cost would have come down, because your standard cost varies with the actual volume. So the variation in the standard cost and budgeted cost, there is going to be a variation between the standard cost and the budgeted cost. This variation happens because your budgeted quantity sold is not equal to the actual quantity sold. The budgeted and actual, there is a variation. This variation leads to volume variance, also leads to some difference in cost. So I have 2 approaches to reconcile. One is a total approach and margin approach. In margin approach, we have 2 approaches. One is called absorption costing and marginal costing. Now what is absorption costing is, when you calculate profit, you will deduct all cost. When you calculate profit, you will deduct all cost: direct material, direct labor, variable overheads, fixed overheads. Under marginal costing, when you calculate profit, you will subtract only the variable cost. You will subtract only the variable cost. You will not be subtracting any fixed cost. You will not be subtracting the fixed cost while calculating the margin. How does this help finally in reconciliation? You will understand in a comprehensive question. So as of now, you can write point number A. BP and AP, budgeted price and actual price, will be replaced with BM and AM. Budgeted price and actual price will be replaced with budgeted margin and actual margin. So whatever in the table you have, you said BP into BQ, it will become BM into BQ, BM into RBQ, BM into AQ, AM into AQ. BM equal to budgeted price minus budgeted cost. You can use the word budgeted cost, you can use the word standard cost. This is at a per unit level, okay? The calculation is at a per unit level. BM equal to budgeted price minus budgeted cost. Budgeted price minus budgeted cost. AM equal to actual price minus actual cost. AM is equal to actual price minus actual cost. Now listen for some time. I have done some mistakes here. I will tell you what mistakes I have done. There is something I want you to correct. Listen for some time. A company wanted to sell its product for 20 rupees. The budgeted cost was 15 rupees. 5 rupees is the budgeted margin. Okay, you wanted to sell for 20 rupees. Your planned cost was 15 rupees, and you can use the word budgeted cost. You can even use the word standard cost. At a per unit level, both are technically same. The budgeted cost per unit or standard cost per unit is technically same. The price is 22. Cost is 18. Actual margin is 4 rupees. The actual margin is 4 rupees. I called the salesperson, asked him that we wanted to earn 5 rupees per unit. You have earned only 4 rupees per unit, so you have not done a good job. I asked the sales guy that I told you to make 5 rupees per unit. You have made only 4 rupees per unit, so the performance is not up to expectation. The performance is not up to expectation. There is some problem with your performance is what I tell him. If you look at in this example, where is the trouble? Is the salesperson at fault according to you? Is there any fault of the salesperson in this example? Why is he not at fault? He has sold it at a higher price. His job is to only sell the product at 20. He is able to sell it at 22. So he will in fact be saying that the person will appreciate me. The person is going to appreciate me, but he is saying 5 rupees has become 4 rupee. So what happens when you do sales variances? When you calculate margin, you don't subtract 18. You subtract only 15. Then what is the difference between 15 and 18? That is your material variance, labor variance, variable overhead variance, fixed overhead variance. So for sales variances, when you do actual margin, you can correct it with a different pen. It's actual price minus budgeted cost. Actual price minus budgeted cost. We don't subtract the actual cost. In fact, many question actual cost will not be there, and if it's there, it's an unnecessary information. It will unnecessarily only confuse us. Actual margin is actual price minus budgeted cost. Actual price minus budgeted cost. Clear? Any doubts on this? Actual price minus budgeted cost. So BM is budgeted price minus budgeted cost. When I want to calculate variance, 20 minus 15, 5 rupees BM. 22 minus same 15, 7 rupees AM. So you can say BM was 5 rupee. You have sold it at 7 rupees. You have done a good job. You have done a good job. He is not he is not to be responsible for controlling that 15 becoming 18. That 15 becoming 18 is your material variances, labor variances, variable overhead variances, fixed overhead variances, which we have seen separately. That's analysis is already done. So when it comes to sales variances, margin approach, the term margin means profit, which is selling price minus cost price. That's the formula. So budgeted margin is budgeted selling price minus budgeted cost price. But actual margin is actual selling price minus budgeted cost price. Actual selling price minus budgeted cost price. Clear? Any doubts on this? Any doubts on this part? Next, approach 3. Margin approach, marginal costing. Margin approach, marginal costing. Margin approach, marginal costing. Simple thing, everything is same. It will be budgeted variable cost in both the formula. BP and AP will be replaced with BM and AM. BM is budgeted price minus budgeted variable cost. AM is actual price minus budgeted variable cost. Budgeted price minus budgeted variable cost, actual price minus budgeted variable cost. We are not bothered about actual data. Question will give you the actual data, but that's an irrelevant information as far as sales variance calculation is concerned. The actual data is useful for your cost variances. But when it comes to sales variances, I don't want to look at the actual information. That will unnecessarily confuse things. State the reasons for adverse sales and cost variances. Now this is just a question, this is not going to come as a standalone question at all, this is just for your understanding. Now first is sales volume, the first variance is sales volume. What we are going to understand is what are the reasons for adverse variance, the opposite of that will be the favorable variance. If sales volume is adverse, if the sales volume is adverse, that is I have sold lesser number of products as compared to what I budgeted for. Can you tell me what can be the reasons for this? What can be the reason for adverse volume? Demand is lesser, so why will demand be lesser? So think about multiple reasons and let me, sorry?
Bad quality.
Okay, drop in quality of product. Okay, I am writing the reasons. What else you get to know? Let's see. Okay, increase in selling price. So this is the interlinkage which I was talking about. There is an interlinkage between sales price and sales volume. If sales price is adverse and sales volume is favorable, or the other way around, you can establish an interlinkage saying that, for example, you do a problem, price is favorable, volume is adverse, price favorable means you have increased the price. So you can say the reason is the company, it is possible that the company has increased the price which has impacted its volume, and that is why it's reflected as favorable price variance and adverse volume. What else can be the reason? Increase in competition. Okay, anything else?
Low production.
Okay, low production. Okay, what else? Low production is not the headache of the sales guy, but still I am writing that as a reason. What else? Now, I think the first reason they talk is poor performance of sales staff. Poor performance of sales staff, that could be one reason, that the sales staff is not doing proper. Second set of reason can be your increase in selling price. I do not want to get into quality of product and all, because that's an underlying issue itself. That's not the issue of the variance part. I cannot go and ask the sales guy, or I cannot penalize him for this. If there is a drop in quality, that will get factored in other areas, not in the standard costing analysis, because in standard costing I am not going to get into the quality of the product part. So I assume that may not be the reason. Drop in quality, or in a practical world that can be the reason, but from a problem solving point of view we may not bring this as a reason. Increase in selling price, increase in competition, drop in market size, that is in the market itself the market size has come down. That could be because of factors like COVID coming in. If COVID coming in, the market size itself will shrink. If market size has shrunk, there is a possibility of my performance also coming down. Also there could be one reason, this is one reason we write everywhere, overestimation of budgeted quantity. Basically I am saying that your budgets were wrong, you did a wrong budgeting and you ended up, this is not only for this, for everywhere. Why is material price variance adverse? One reason we will say is overestimation or underestimation of the planned selling price, the standard price. Overestimation or underestimation of the standard price can be one reason for your price variance. So that will be one reason in all the variances. Let's look at what are there. Poor performance by sales staff, deterioration in market condition either due to macroeconomic environment or changes in the industry environment, both you have talked about, new competitors, deterioration in the company's or brand reputation, making a product less desirable to customers, which is what you were talking about, a quality angle. From an answer point of view I may not write this, but this can be one reason. Sales price, lack of goods or services to sell as a result of production problem. So all these points you have discussed about. Next is sales price. Let me know what can be the reason for adverse price variance. Adverse price variance, what can be the reason? The selling price is lesser than what you wanted to sell at. So what can be the reasons for that? Sorry? Okay, so increase in quantity sold, or basically I will say the management went ahead and reduced the price to increase the quantity sold. To increase the volume they have gone ahead and reduced the price. What else?
Similar products available in market.
Increase in competition or substitute product. Competition or substitute products. Basically your Porter's 5 forces model. What else?
Drop in market price.
Drop in, okay. Okay, impact on demand leading to lower prices. in the market there is no demand. I think I'll again go with the first part, poor performance of sales staff, and another reason can be that you overestimated the selling price originally. You ended up overestimating the selling price. That's a reason we write in most of the variances, that there could be an overestimation. When you do the interpretation, when you solve problem, one of the reason you will talk about is the overestimation part. Poor performance, deterioration in market condition. Okay, they have just talked about 2 points. You can link with your quantity sold and all, that linkage can be done. The next is material usage. Why will material usage be adverse? That is, you have used more quantity than what is needed. You have used more raw material quantity than what is needed. What can be the reason for this? Sorry? Okay, okay, excess wastage. What else? Which product? Raw material. Okay, raw material is of substandard quantity, substandard quality. You got a bad quality product, because of which, or technically I can say this as favorable price variance. You ended up buying a product at a lower price. You wanted to buy a cheaper raw material. When you buy a cheaper raw material, what happens is, you see all those two subcomponent in many variances. One will be favorable, other will be adverse, the interlinkages. If it is a logical thing, we did a problem where both were favorable. If both being favorable means the company has done an excellent performance. That is basically the good performance of the company. One favorable and other adverse is basically the action taken by the management. You wanted to, for example, you penalize the production manager because there is an adverse usage variance, and reward the purchase manager. Now when you do variance analysis, you will get to know that you need not reward the purchase manager, you need not penalize the production manager, because this purchase manager ended up buying a inferior. In fact, instead of rewarding this guy, you may even end up penalizing this guy, because he ended up buying a inferior quality raw material. Because he bought an inferior quality raw material, my usage went up. My usage went up because it's a bad quality raw material, I can't do much about it. What else can be there? Excess wastage, raw material is of substandard quality. Okay, problem with plant and machinery, which can lead to your rejection or wastage. What else? That is, your raw material is of substandard quality. You ended up buying it at a lower price. Mostly these. The one another thing which we bring in is saying that your budgets were wrong. The budgets which we had estimated, that could be wrong. Poor performance by, okay, this is poor performance by, okay, this we did not talk about. Poor performance by production department staff leading to high rates of scrap. That high wastage, whatever is happening, it could be because the production department is not working. Substandard material, faulty machinery. So these are the multiple reasons which can be there. When it comes to your material price variance, see, the material price variance can be adverse because poor performance by the purchase team. Poor performance by the purchase team. Second reason could be that you could have changed the supplier. You could have changed the supplier. When you change the supplier, it could be that it leads to favorable, it can also possibly lead to adverse variance. Both can happen. I am changing the supplier because I wanted to cut down on the cost side. We saw adverse material usage variance. One reason for that can be also changes in the supplier. If you change the supplier, he is going to give you a different grade of material or a slightly different composition, and that can also lead to impact on the quantity used. So poor performance by the procurement department staff, using higher quality material than that was planned, price increase by supplier or other changes in the market condition. Using higher quality raw material, the production guy said that I wanted a better quality raw material now. So the moment you wanted a better quality raw material, again it will end up impacting the variance. Next is your labor variances, labor efficiency variance. Now coming to labor efficiency variance, I can have adverse labor efficiency variance because of what reasons? Sorry? Usage of? Okay, unskilled labor, or technically you can say lack of trained workforce. You did not train them properly. So lack of trained workforce. What else? If you pay lesser to employee, if you pay lesser to employees, that is, you cut down on the rate side, can it impact efficiency? Because your motivation levels will come down. Motivation levels will come down. So lower pay impacting motivation and hence the efficiency. There is an impact on the motivation and hence the efficiency again has dropped. The efficiency has dropped. Usage of unskilled labor, lack of trained workforce, the mix which you are using, the mix can also be different. You are originally planned for a mix. Now in the mix you wanted to use more of skilled workforce, here you have used more of unskilled workforce or more of semi-skilled workforce. That can also lead to impact on the efficiency, and another reason can be that you did not estimate the efficiency properly. Original estimation itself is wrong. Poor supervision, using less skilled workforce than originally intended, meaning they take longer to work. Low grade material, okay, you are using the raw material is not good. Because raw material is not good, what happens is it leads to bad product, finally it impacts your labor efficiency. Disruption of material supply leading to workers being unable to proceed with production. This is idle time. Okay, I did not talk about a reason called as idle time, because the idle time can happen because of lack of material, lack of machine, lack of money. It could be anything. Material is not available or machinery is not available. Then direct labor rate variance, opposite of what happens on the efficiency side. You have ended up paying more to the laborers in order to motivate them. That leads to, or if you are using more of skilled workforce, if you use more of skilled workforce, for every item one of the sub reason we will have is, if was the budget wrong, for the company. Clear? Now I will come to the reconciliation part. Now listen for some time, I don't want you to write anything. There are totally 4 approaches to do reconciliation. Your reconciliation which you do is based on 4 approaches. The 2 broad approaches are called absorption costing and marginal costing. These are 2 broad approaches. When you do reconciliation, your starting point can be BP, budgeted profit reconciled with the actual profit. Budgeted profit of the organization reconciled with the actual profit. This is the normally used one and the preferred one. Sometimes you may start with standard profit and reconcile with actual profit. What is standard profit? Standard profit is to be computed based on actual output. You said you wanted a profit of 20 lakh rupees. Then you are saying we did lesser volume, so my standard profit is 18 lakh. My standard profit is 18 lakh. Actual is something else. So your starting can be 20 and you reconcile with the actual, or your starting can be 18 and you reconcile with the actual. And then you have again here BP into AP, SP to AP. Now when you do reconciliation, let's take the example of material variances. The material cost variance is split into what? What is the split of cost variance? Price and usage. Usage is split into mix and yield. Now any problem, if you have any sub variances, for example there is a question where you have yield and mix, then you should not write the usage variance in the reconciliation. In the reconciliation you cannot write usage variance if you have yield and mix, because if you are writing usage variance it will become double counting. Because usage is only split as yield and mix. If you are writing price and usage, you should not write cost. The rule is we should try to write the sub variances. For example, somebody writes material cost variance, then everything of material variance is considered there. If you are not writing the sub variance and just writing the material cost variance, that reconciliation will not be of much use, because I am now thinking what is the reason for the material cost variance, because I want to know whether it's price or usage. In usage also I want to know whether it's yield or mix. So the rule is you will have to write the sub variances. So the starting part is budgeted profit or standard profit, depending on the approach you are following. If you are following BP to AP approach, you will write the budgeted profit as the first line. If you are following SP to AP, you will write standard profit as the first line. Add favorable variances and you will deduct adverse variances. So as of now I am just writing add or less, because I don't know which will be favorable, which will be adverse. Add or less favorable or adverse variances. So what will come here is material price variance, material mix variance, material, I don't want you to write, it's covered in the theory part. If something is to be written I will tell you. Material price, material mix and material yield. it will come in all the places. Material price, material mix and material yield will come at all the places. This is the first variance, material variance. Then you have labor rate variance, labor yield variance, labor mix variance, labor idle time variance. Again it will be captured at all the places, all the four approaches: labor price, sorry, labor rate, labor yield, labor mix and labor idle time. Then you have VOH expenditure variance, VOH efficiency variance. Again you end up copy pasting this, again you end up copy pasting at all the places. Then you have FOH expenditure variance, FOH capacity variance, FOH calendar variance, FOH efficiency variance. This is where the first change is going to happen. I am going to have a change done here. Now depending on the approach, expenditure variance will come at all places. Expenditure variance is the difference between budgeted expenditure and actual expenditure. If there is any variation in the expenditure, it will lead to difference in profit, and it is recognized in absorption costing as well as marginal costing. It is recognized in absorption costing as well as marginal costing. But when it comes to your volume variance, the volume variance, the breakup is your capacity, calendar and efficiency. The breakup is capacity, calendar, efficiency. It will come here. In this approach it is not applicable, I should not capture this when you are following marginal costing approach. So for example, you do a problem under marginal costing variances, we need not calculate FOH variance itself, we just need to calculate one variance in FOH, which is FOH expenditure variance. Now why is this happening? Because under marginal costing you don't try to consider this item for inventory valuation. That's first thing, you don't consider this for inventory valuation. Second, you don't try to even absorb this onto the cost of the product. Why you don't absorb this onto the cost of the product? Because your profitability is measured through PVR and not through the net profit margin. So what organizations do is they fix a price based on the variable cost and then say whatever I earn should contribute towards fixed cost and profit, I am not bothered about volume going up or volume coming down, but the only worry is that fixed cost what I initially planned, that should not vary. What I had planned initially, I would have planned initially saying that fixed cost has to be 5 lakh, then in the end I need the fixed cost to be 5 lakh. If it is going up or coming down, that can lead to variation in profit. That's called expenditure variance. So expenditure variance will come in all the four places, but volume variance will come only in absorption costing. It will not come in marginal costing. There is another reason for this which I will touch upon in some time. Sales margin price variance, sales margin volume variance. You will have to use margin approach. You cannot follow the approach of total here. For doing a reconciliation, I will have to follow margin approach. So SMPV, SMVV, I will follow this at all places. I don't have a problem. SMVV, sales margin volume variance. Sales margin volume variance is the difference between budgeted quantity and the actual quantity. Difference between budgeted quantity and actual quantity sold by the company. Now this you consider here. Okay, not SMVV, let me write the breakup. SMQV, sales margin quantity variance and sales margin mix variance. These two numbers can be different. Why will it be different? Because one will be under absorption costing approach, another one will be under marginal costing approach. And technically what happens is, unless there is some stock information, if stock is not there, if there is no opening stock, closing stock and all, SMVV under marginal costing, SMVV under marginal costing is equal to SMVV under absorption costing plus FOH volume variance. This is a interlinkage. Sales margin volume variance under marginal costing. What happens under marginal costing is, let's take an example. 10 rupees is the margin per unit. You will say 10 into 20,000. You will say 10 rupees is the margin. So you will say 10 into 20,000. What is 20,000? Is the difference between budgeted output and the actual output. The difference. Absorption costing margin is 6 rupees. Why it is 6 rupees? Because 4 rupees is fixed overhead. 4 rupees fixed overhead, and volume variance will be 4 into 20,000. Volume variance will be 4 into 20,000. This is provided there is no opening and closing stock issue. If that is there, then this equation will not fit in. But if there opening closing stock issue and all is not there, this equation is going to fit. 10 into 20,000 is SMVV under marginal costing, and absorption costing is 6 into 20,000, and your volume variance is 4 into 20,000. Indirectly, moment you write this, you have indirectly written that red based area also. Whatever is shaded in red, that is also written as part of that variance. Because your SMVV under marginal costing is nothing but total of these two and this. So indirectly you have considered the FOH volume variance in the sales margin volume variance. FOH volume variance is indirectly considered in sales margin volume variance. This too is not applicable. Why this is not applicable is the difference between budgeted profit and standard profit is the volume variance. The difference between budgeted profit and standard profit is the volume variance. So if you are starting with standard profit, you cannot again subtract the volume variance, because standard profit, the gap between budgeted profit and standard profit is going to be SMVV. The gap is going to be SMVV. I will talk about certain formula and all. In the end, you will get actual profit, which is going to be same for all the 4 situations. Sometimes it can be different. The AP can be different for marginal costing and absorption costing. That's because of the stock valuation. Your stock valuation is different under absorption costing and different under marginal costing. You could have learnt about this at CA Inter, that the profit which you calculate under absorption costing and marginal costing will be different, and the reason for that is inventory. You will see this as we proceed. So the core difference is SMVV is to be ignored under Approach.to and Approach.4, or simply you can say SMVV is to be ignored if you start with standard profit. SMVV is to be ignored. When I say SMVV, the breakup of your SMVV, which is SM quantity variance and SM mix variance. Sales margin volume variance is to be ignored if the starting point is standard profit, and FOH volume variance is to be ignored if you are following marginal costing approach. Approach 1, consider all variances. Approach 2, because it starts with standard, please ignore SMVV. Approach 3, because it's marginal costing, ignore FOH volume variance. Approach 4, it is marginal, starting with standard profit, ignore FOH volume as well as SM volume. Ignore your FOH volume as well as your SM volume. That would have been auto deducted when you start with standard profit. It will get auto deducted when you start with standard profit. Clear? Any doubts on this? Now these are your variance approach. Budgeted to actual profit, absorption costing, you will see everything being considered. There is no not applicable. Then you follow standard profit. This is what is the equation I was talking about. Budgeted profit less the sales volume variance is standard profit. The gap between them is the standard profit, the volume variance. So you cannot again deduct here. You cannot again subtract here, because again subtraction will lead to double counting of the same thing. When you follow marginal costing approach, FOH variances, the FOH volume, expenditure will be considered. Again I am repeating, expenditure will be considered, but volume will be ignored. Volume variance will be ignored. And if you start here, sales volume is auto deducted here, so this is also ignored, this is also ignored, and this is the equation. Sales margin volume variance is equal to sales margin volume variance under absorption costing plus FOH volume variance plus FOH. This equation will work provided there is no closing stock, provided there is no variation in stock. Even closing stock can be there, but there is no variation in opening and closing stock. If that happens, this equation will work. Clear? Any doubts till now? Any doubts till now? Okay. Now, how do I calculate this budgeted profit, standard profit I have two approaches, absorption, marginal. Budgeted profit is BM into BQ. What is BM is what you learnt in the variances. When I did sales variances, I told you what is BM. BM is budgeted price minus budgeted cost. Standard profit is BM into AQ. Technically this is column 1 of your sales variances, this is column 2 of your sales variances. Column 1 and column 2, and the gap between column 1 and column 2 is sales variance, sales volume variance. The gap between your first and second column is sales volume variance. That's why I said sales volume variance is auto considered. Here also it's the same thing, BM into BQ, BM into AQ. The only gap is minus BFOH minus BFOH, because the BM which you use does not subtract fixed overhead. The BM which you use in marginal costing does not subtract fixed overhead, because the BM for marginal costing is budgeted price minus budgeted variable cost. So BM into BQ subtract budgeted fixed overhead. Again BM into AQ subtract budgeted, no actual fixed overhead subtraction, because the BFOH AFOH gap is your expenditure variance which will be separately considered. So BM into BQ, technically this is column 1, this is column 2 with a common item which will be deducted from both. So in both the places you will have a common item which will be subtracted. So technically difference between this will be SMVV again. The difference between this will be SMVV, sales margin volume variance. Clear? Any doubts on this? Budgeted margin into budgeted quantity. Again budgeted margin into actual quantity. What is budgeted quantity? Is the output which you wanted to sell. Actual quantity is the output which you have sold. Again budgeted quantity is what you wanted to sell. Subtract budgeted fixed overhead. This and this will match. This and this will match. This and this will not match. Many a times it will not match. This and this will see some gap because of the way which this is calculated. You will see there is a difference between standard profit under absorption costing and standard profit under marginal costing. There is going to be a gap between these two items. Clear? Any doubts on this? Any doubts in whatever I have explained? Budgeted profit under absorption costing, budgeted units into budgeted profit per unit, actual units into budgeted profit per unit, budgeted units into budgeted contribution minus BFOH, actual units into budgeted contribution again minus BFOH. You will have to subtract the budgeted fixed overhead. What you subtract is budgeted fixed overhead and not actual fixed overhead. Clear? Any doubts? Okay. I will go to the next segment. Now we are going to start with the advanced set of variances. One advanced set of variances you are going to see is market size and share. Then you are going to see something called as planning and operating variances. You will also see something called as activity based costing and variance analysis, and there will be relevant costing approach. In between I think there is an area called as reverse working, which is continuation of part 1, and it is part 1 which is your cost and sales variances and reconciliation put together. I normally don't discuss reverse working in the class, I give videos for that, but I will see if there is a need, I will do 1 or 2 problems, but that is later. Now let us first understand this market size and share variance. Now my original plan was to sell 1 lakh unit. I will come to how did I arrive this 1 lakh in a minute, but my original plan was to sell 1 lakh units. Actual volume, I ended up selling 80,000 units. Is this a favorable scenario or an adverse scenario for the company? I planned to sell 1 lakh units, I have ended up selling only 80,000 units, so this is an adverse scenario for the company. Just a minute. Okay, this is an adverse scenario for the company. Now how did I arrive at this 1 lakh is, I am in an industry, in that industry I was able to estimate what will be the market size. So my plan was to do 5 lakh into 20%, 5 lakh into 20%, the industry is 5 lakh units, you will do 20% of that, that was your original plan. COVID came in, this 5 lakh of the industry shrank to 3 lakh. 5 lakh of the industry became 3 lakh. Industry size coming down, industry size coming down, is it in the control of the company? It's beyond the control. You can try to influence it. You can try to, for example, if number of CA student registrations are coming down, let's assume that is the trend recently. If that is coming down, many academies may try to conduct some career counseling program. They may try to tell students that this is a good career, and maybe we can try to influence. But still, if the overall registrations at ICA level is coming down, it is beyond our control. It cannot be under the control of us, because at an overall level there is a dip in the registration. So industry has gone down by from 5 lakh to 3 lakh, and the reason was COVID. Now think and tell me, do you see this to be a favorable performance or an adverse performance, and a logic for that? 1 lakh becoming 80,000. I am giving you an extra information. Originally planned industry size was 5 lakh. Now it has come down to 3 lakh. Is it a good performance, bad performance, and why? Why do you say good performance? Sorry? Okay, it should have been 60,000. Okay, my market share is more than what I had initially anticipated. Technically, this 1 lakh unit which you call it as budgeted volume, I need another thing called as new budgeted volume. In fact, it's called revised budgeted volume, but I don't want to use the word RBQ, because there is, in your variances there will be an item called as RBQ. So we use a word called as NBQ, new budget quantity. Instead of using the word RBQ, we'll use a word called as new budget quantity, and my new budget should have been, the gap between 1 lakh and 60,000 is called market size variance. The gap between 1 lakh and 60,000 is called market size variance, which is also called as a planning variance. You learn about planning and operational later, but planning and operational variance, when you do, we are focusing only on the cost side. Market size and share is a separate thing, which is on the sales side part of it. So 1 lakh and 60,000 gap is called market size variance. It is a planning variance beyond the control of the company. It is a planning variance beyond the control of the company. The gap between 60,000 and 80,000 is called market share variance. Gap between 60 and 80 is called market share variance, and it is within the control of the company, and also called as operating variance. So if you want to penalize or reward your sales manager, please do it for market share and not for the overall variance. Not for the overall variance. During COVID situation, 1 lakh becoming 80,000, you cannot fire your sales manager. Just because 1 lakh has become 80,000, you cannot say him that why did you reduce volume by 20,000, you are not doing good performance, and you cannot tell him to move out. Whereas in reality, he has done a superior performance. He has in fact done an excellent performance, because he was able to improve the market share. In fact, he is eligible to get reward rather than being penalized. Now, when we did sales variances, we had one material problem and two material problem. One material problem was BP, AP, you can even say BM and AM, that is your, from a margin approach point of view. Here we had BQ, AQ. I did not have an item called as RBQ and all in between, okay. So this is for single material. In between this, an item will come called as NBQ. In between an item will come called as NBQ. I don't want to use the word RBQ, but it's technically revised budget. We use the word new budget. So my table will have BP into BQ, BP into NBQ, BP into AQ, AP into AQ. This is called price. Put together is called volume. In that, this is size and this is share. Market size variance and market share variance. Market size variance is BP into BQ minus BP into NBQ, and market share variance is BP into NBQ minus BP into AQ. In the example which I gave, budgeted quantity is 1 lakh, new budget quantity is 60,000 and actual quantity is 80,000. Clear? Any doubts on this? Now write market size and share variance. Market size and share variance. Situation 1, single FG. You can put the chart, computation table and the formula. I will give some explanation on BQ and NBQ in some time. Chart, computation table and the formula. put the chart, then the computation table. We can do this under total approach, we can also do this under margin approach. Total sales variance, sales price, sales volume. Volume is split as market size and market share. Your market size and share, only the advanced variances have been tested in exams. Till now, if in 8-9 questions have come in standard costing, out of that 7-8 would be from your advanced variances, only 1 or 2 have come from the basic cost variances. Otherwise, what is frequently tested is only the advanced variances. Market size I think has come twice in exam. Planning and operating also some 2-3 times has come in exam. ABCs again 1-2 times. So, what is frequently tested is your advanced set of variances. Any doubts on the single FG scenario? I hope all of you have written the formula as well. Total sales variances BP into BQ minus AP into AQ, the smallest one minus the biggest one. Sales price variance BP into AQ minus AP into AQ. Sales volume BP into BQ minus BP into AQ. Market size BP into BQ minus BP into NBQ. Market share BP into NBQ minus BP into AQ. If you are using this way, then negative variance would indicate, negative answer would indicate favorable variance and positive answer would indicate adverse variance. Any doubts on this? Can you proceed? Clear? Next is multiple FG scenario, right? Multiple FG. Okay, before that, all right, NBQ note. NBQ is basically new budget quantity computed on the basis of revised market size, computed on the basis of revised market size. NBQ is equal to new market size into originally planned market share. New market size into originally planned market share. New market size into originally planned market share. You need not even technically remember the formula. Original plan was 5 lakh units, we were to sell 1 lakh. Revised is 3 lakh units, so how much you should sell? That's 5 lakh is equal to 1 lakh, 3 lakh is equal to question mark. So that 3 lakh is equal to question mark is 3 lakh into 20% technically. Any doubts on this? Next, multiple FG, situation 2, multiple FG. Multiple FG, you can write along with me. BP, AP, BQ, AQ, in between RBQ comes, and in between NBQ comes. In between RBQ will come and NBQ as well come. Technically the second column is revised budget quantity only. Technically it's a revised budget. In order to differentiate terms, we use the word new budget quantity. So table will be BP into BQ, BP into NBQ, BP into RBQ, BP into AQ, AP into AQ. BP into BQ, NBQ, RBQ, AQ and AP into AQ. Now listen for a minute, slightly important one, not a tricky one but important. This is price, together is volume, this is mix, this comparison was quantity, the first two parts is quantity, and when you have multiple FG, the split of quantity is market size and share, and not the split of volume. Volume will not be split as size and share. So this is called size, this is called share, and I'll explain why only quantity split as size and share. The logic is any increase or decrease in the quantity sold, can be because of the market side variation. You factor that as market size and share. The actual quantity will not only have the variation in the quantity, it will also have the variation in the mix. Any variation in the mix has no linkage between the market size and share component. There is no linkage of market size and share component as far as the changes happening on the mix side. So it's the quantity variance, which is even earlier also it's the quantity variance only, but volume is equal to quantity variance there. Because we did not have multiple product. So technically I split volume as size and share. That volume is nothing but quantity there. Here it will be like this: total variance split as price, volume will be split as quantity, mix, and quantity will be further split as size and share. Size and share is a sub breakup of quantity variance, it is a subsplit of quantity variance. Can you tell me what is the formula for market size variance? BP into BQ minus BP into NBQ. Market share, BP into NBQ minus BP into RBQ. Volume variance, BP into BQ minus BP into RBQ. Mix variance, BP into RBQ minus BP into AQ. Volume variance, BP into BQ minus BP into AQ, and your overall price variance is BP into AQ minus AP into AQ, and the overall sales variance smallest minus the biggest, BP into BQ minus AP into AQ. Put the chart, write the formula, put the chart computation table and then write the formula. The computation can be done under total approach, can also be done under margin approach. Problem mentions something, follow that, else your wish. Even in margin we have absorption costing, marginal costing. Let me know if there are doubts here. Your computation table, BP into BQ, BP into NBQ, BP into RBQ, BP into AQ, AP into AQ. Clear? Can you? I'll move to the next segment, which is another important part called as planning and operating variances. Now, you have already done this planning and operating variances as part of market size and share variance. Market size and share variance is technically considering this aspect called as planning and operating variance. There is nothing much to note down, listen for some time. I told my purchase manager, buy raw material at rupees 10 per kg. This was the instruction given to the purchase manager, that you will have to buy the raw material at the rate of 10 per kg. The raw material is basically dependent on monsoon. If monsoon is bad, the raw material availability will come down and the prices will go up. So this raw material is an agricultural commodity whose effect or whose price is dependent on monsoon, and unfortunately there was a very bad monsoon. Monsoon is not under the control of the company. The company cannot have any control on how the monsoon is going to be. So because of which, what happened is, in the market industry, raw material prices gone up to rupees 30 per kg. So what was 10 per kg, it went up to 30 rupees per kg, and this was a factor which was beyond the control of the company. Company could not do much about it, because in the market raw material prices shot up because there was limited availability of raw material. So because of limited availability, you saw the prices going up. It can be other way around also, that sometimes there can be a surplus availability of raw material and the prices can also come down. So 10 became 30 in the market. Purchase manager purchased raw material at rupees 25 per kg. He purchased the raw material at rupees 25 per kg. So I instructed him to buy at 10 rupees per kg. He ended up buying it at 25 per kg. In the market, in the interim period, the raw material prices have gone up from 10 to 30. The raw material prices have gone up from 10 to 30. This is something which the company could not do much. It was beyond the control of the company, and unfortunately this 10 rupees has become 30 rupees. This 10 has become 30. The accountant, the management accountant, prepared the variance statement. In the variance statement, what will you take as standard price? In the variance statement, you have been doing variance calculation so many times. So what will you take as standard price? Yeah, participate. What will you take as? I don't think so you take 30. We have not tried to revise the standard anywhere. So we take normally the standard price to be 10 rupees, because I gave the instruction as 10 rupees. Actual price is going to be what? 25. Material price variance, favorable, adverse? Adverse. It is going to turn out to be an adverse variance. One thing I can do is, after this is calculated, I can ask for an explanation. In the explanation he can give this. In the explanation he can mention that in the market the raw material prices have moved up from 10 rupees to 30 rupees. So this was something which we could not anticipate, but however, considering the relationships which I have with the supplier, I could try to bring in the raw material at the rate of 25. This is an explanation he can give. But the variance statement is showing an adverse variance. The variance statement is showing an adverse variance, and this is a problem of standard costing. This is a problem of standard costing because your variances are going to show adverse variance. The same happened with market size and share example. In the market size and share example, I said I wanted to sell 1 lakh unit. In the industry, market went up or came down. 1 lakh should have become something else. You have attained something else. What may look like a favorable variance may turn out to be an adverse variance. What may look like an adverse variance may turn out to be a favorable variance. So that was a problem. Ideally, in this case, has the purchase manager done a good job or a bad job? He has done a good job. He has been able to buy it at 25 as compared to the price of 30. He was able to buy this at 25 as compared to an original expected price of 30 rupees. So he was able to buy it at a lower price. Now what we are going to do is, we want to prepare something called as planning variance, operating variance, planning variance and operating variance. The table for this, how do you calculate variances is, let's assume there's a single raw material. You will say SP into SQ, SP into AQ, AP into AQ. Another table will be prepared. The first table is for planning variances. The second table is for operating variances. So there will be one table for planning variance and one table for operating variances. You are going to prepare two tables. There will be one table called as planning variance table, second table called as operating variance table. If you have multiple material, do SP into SQ, SP into RSQ, SP into AQ, AP into AQ. Similar thing can come for the operating variances also. Now what is planning variances? For planning variance, standard means original standard. Standard means original standard and actual means revised standard. The term actual, be very clear. The term actual means the revised standard. The term actual means the revised standard which the organization is bringing in. It may bring in whatever the revision. Sometimes there can be a revision in price. Sometimes there can be revision in the quantity to be used. You are planning to use 5 kg per unit of FG. Now you will suddenly say instead of using 5 kg, we will use only 4.5 kg. So you can do anything. And operating variance, standard means revised standard, actual means actual. Actual is basically actual. Now what is going to happen in this is, when you do your planning variances, 10 minus 30 will be the planning variance. 10 rupees will be taken as standard price. I am not getting into the quantity part, let's leave that. This will be 10 and this will be 30. This will be 30. The actual price for the purpose of planning variance will be 30. What is 30? Is the revised standard. You have to change the standard from 10 rupees to 30 rupees. This will become 30 and actual is 25. Actual is going to be 25. So when you do your operating variances, you will say material variances is equal to, you will say material variances is equal to material price variance 30 minus 25. Material price variance will become 30 minus 25, which will give a favorable answer. Instead of me seeking an explanation from my manager, I want to formalize this in my variance computation itself. So planning and operating variances will come into picture if there is a change in operating condition. If there is a change in operating condition, you will have to bring in the concept of planning and operating variances. If there is no variation in the operating conditions of a company, then planning and operating will not come into picture. So what can be the variation in operating condition? Raw material prices going up or coming down, raw material usage going up or coming down because you made some changes to the way product is manufactured, or labor rates going up or coming down, Are labor efficiency undergoing a change? So multiple changes can happen. If any of those changes happen, you will have to factor that as planning and operating variances. Clear? Any doubts on this? Planning variances, standard means original standard, actual means revised standard. Operating variance, standard means revised standard, actual means actual. When I ask AP here, you will have to think AP as the revision in standard. Many students get confused and they say AP means 10 rupees, sorry 25 rupees, I'll take it as 25. That will not work. AP for the purpose of planning variance. When you do planning variances, focus on the part, is there any change in the standards by the company? Have they made any changes? Now why are we doing this is, planning variance is uncontrollable in nature and I am not going to penalize. I am not going to penalize the responsibility manager. He could be a purchase manager, he could be a sales manager, he could be a production manager. He will not be penalized, he will not be rewarded. In case there is too much of planning variances happening, then there is a problem either with my planning team or my operating team would have incorporated budgetary slack in their processes. So if I have to do my planning change, if I have to have lot of planning variances are there, then there is something going wrong in the planning team. If too much of it is happening, because I do understand some factors can be beyond control, but still there is a need to forecast. Organizations do forecast how the monsoon is going to be, because when they do their pricing calculation, they do anticipate how the monsoons are going to behave, and based on that they try to fix their prices, because you cannot suddenly make a significant increase in prices just because raw material prices have started moving up. When the current environment conditions are different from anticipated environment condition, then there is a need to revise budget and do variance analysis. Planning variances, revised standard compared with original standard. Operating variances, actual compared with the revised standard. The difference between the original and revised is called planning, and the difference between the revised and actual is called operating. Your planning variance is the difference between original standard and revised standard. Operating variance is the difference between revised standard and actual. When it comes to sales variances, there are two types of variances, price and volume. Volume variance, planning and operating, is market size and share. Volume variance, whatever changes has to happen, that is your market size and share. If any price changes are happening, that can also be analyzed as planning and operating, where for the purpose of planning and operating variance, budgeted price would be the original budgeted price, actual price will be the revised budgeted price, budgeted price will be the revised budgeted price, actual will be the actual. So that way you can end up doing the variance computation. Okay, we'll cover that initial theory part which we have not discussed till now. Theory may not be that much critical from a standard costing point of view, but still in exam we have seen questions coming from theory because they have combined it with a practical area. So with the practical area they ended up asking a theory question as well. So let's look at the initial theory. The first component is on planning and operating variance. This is self-explanatory, we have done it multiple times. Planning variance is the gap between the original standard and the new standard set by an organization. Operating variance is the gap between the new standard and actual. Whenever the operating conditions undergo a significant change, whenever there are significant changes in operating condition, it may lead to revision in standards, and if there is a revision in standards, it may lead to planning variances. The second part is market size and share variance. Again, this is also done. Market size and share variance basically occurs in case there is a need to revise the original budgeted quantity with the new budgeted quantity due to changes in market size. Changes happening at the market size level are beyond the control of the company. They cannot be under the control of the company, so they cannot be held responsible for this. So these changes are beyond the control of the company. So any gap between the original budgeted quantity and the new budgeted quantity is called as market size variance, and the comparison of NBQ with actual, the new budgeted quantity with actual, is called as the market share variance. Market size is a planning variance and market share is an operating variance. Just give me a minute. Next is variance analysis and activity based costing. This is an area I am going to touch upon in some time. At inter level, you would have learnt about activity based costing. You are going to see again activity based costing as part of strategic analysis of operating income. I think chapter 9 or 10. You will see there again this concept called as activity based costing. If you remember, what ABC used to do is, ABC used to find a driver for every cost. ABC used to find a driver for every cost. The objective is convert most of the cost into variable cost. Convert most of the cost into variable cost. ABC tries to analyze the cost, understands the base reason for a cost. Once you get to know what is the base reason for a cost, you are trying to convert your fixed cost into variable cost. So when you do variance analysis and activity based costing, mostly it's variable overhead variances. We try to convert the fixed overhead variances into variable overhead. But when you do variable overhead variances, you cannot do SR into SH, SR into AH, AR into AH. That approach will not work. Why will it not work is, under your traditional system, you believe all overheads are driven by labor hours or by machine hours. Here what will happen is, inspection cost will have a driver called as inspection hours. So if you are required to analyze the variances for inspection cost, it will be SR into SIH. What is SIH? Standard inspection hours. SR into AIH, actual inspection hours. AR into AIH. If you are trying to analyze a cost called as power cost depends on kilowatt hours. So SR into SKWH, standard kilowatt hours. SR into AKWH, actual kilowatt hours. AR into actual kilowatt hours. Certain expenses can be driven by number of receipts, certain expenses can be driven by number of deliveries, certain expenses can be driven by number of invoices. So you find out the base reason for the driver, and instead of having SHAH, you can have SKWH, AKWH, SIH, AIH, standard inspection hours. So multiple things can change. ABC approach is based on the assumption that overheads are generally basically variable. Your variable with the delivery numbers and not the unit output. It will be variable, but it will be variable on the basis of invoices, on the basis of number of deliveries, on the basis of number of receipts. So there can be multiple reasons for this variable cost to be there, but it will not be based on the output most of the time. It can be even based on the output, but most of the times it will not be based on output. So if your overhead expenses is not based on the output, if it's not based on the output, then you will have to calculate your overheads. The variances remain the same, efficiency and expenditure, but the variances will be based on your variances will be based on multiple other drivers. You will have to take efficiency variance and expenditure variance. Nothing changes there. It continues to remain efficiency variance and expenditure variance, but the calculation is going to be slightly different. People who are the other side, if you find it difficult, there are places in the end, so you can shift there. There are a lot of chairs in the end. Okay. Variances would be done in the similar manner as that of VOH variances. However, we need to use correct cost driver, which is customer delivery, dispatches, customer orders, production run. Your driver can be different thing. You may use standard customer deliveries, actual customer deliveries, standard customer orders, actual customer orders, standard production run, actual production run. Learning curve, an area which I am yet to touch upon, but I will just explain what happens in learning curve. Learning curve basically says that the successive time taken will keep coming down. For example, when I tell you to do something, first time you will take 20 minutes to do it. Second time, if I tell you to repeat the same work, you may take lesser than 20 minutes. The time taken will progressively keep coming down. The time taken to complete a task will keep coming down. So when the time taken keeps coming down, you said you will take 10 hours to produce a product. So what you do is, standard time is always calculated with the help of actual output. If my output is 1000 units, my standard time will be 10,000. But that is a wrong way of doing things, because you also need to factor in learning curve benefit. If the first unit takes 10 hours, 1000 units may end up taking only 4000 hours. You will understand when you do learning curve approach, but 1000 units may end up taking only 4000 hours or 5000 hours. That is the benefit of learning curve. So if there is a learning curve situation, your standard time will be calculated with the help of actual output, there is no doubt on that, but it is not that 1 unit is equal to 10 hours, 1000 units is equal to question mark. That approach will not work, or you cannot say actual output into input by output. That approach will not work, that will not give you the right answer. Because of learning curve benefit, you will see that the time to be taken would be significantly lesser. Learning curve indicates the amount of time taken to produce every successive unit will reduce. Understanding of learning curve will be critical while computing labor efficiency variance, as benefit of learning curve needs to be considered while calculating the standard time. The next approach is relevant costing approach. Though theory has not come, 2 times in exam a question came on relevant costing with standard costing. It's a problem solving area. What is relevant costing approaches? In relevant costing you learnt that some expenses the relevant cost is 0, some expenses the relevant cost is, if you are paying 5 rupees but you will consider the relevant cost to be 10 or 15. Let's, from a standard costing point of view, let's look at 2 scenarios. One scenario is I do not have any limiting factor. Second scenario, I have a limiting factor. Let's assume raw material is a limiting factor. When you do your raw material variances, you say is inter dana under room, other room irukla 6:30 avங்களுக்கு. Okay, coming to the relevant costing approach. So if labor or if material is a limiting factor, what you do, SP into SQ, SP into AQ, AP into AQ. Standard price was 4 rupees, you calculate. Now let's assume I wasted 1000 kg of raw material. I ended up wasting 1000 kg of raw material. Your variances will say SP into SQ, 4 into whatever the time quantity you wasted, you will get as the variance. But because I wasted this, my production came down. Because raw material is a limiting factor. I wasted that. Production unfortunately came down. Because of wastage of raw material. And production coming down will lead to decrease in sales. Because a limiting factor is a situation where the demand for the factor is more than the supply, which means I have demand in the market. Market demand is there, but somewhere I did not have adequate capacity to meet the demand. So I was not having the capacity to meet the demand. In that I am wasting raw material. So when you do your variance calculation, when you do material price variance, no change. When you do labor rate variance, no change. When you do variable overhead expenditure variance, no change. But when you do your efficiency part, material usage variance, the formula for material usage is SP into SQ minus SP into AQ. The standard price will be equal to normal standard price plus opportunity cost. Why plus opportunity cost is you are wasting this resource. Though you are buying it for 4 rupees, but the resource is worth 25 rupees. Why 25 rupees? Opportunity cost of 21. There is an opportunity cost of 21. So in case there is wastage of resources, when I am calculating my variances, provided it's a limiting factor, okay. If it's not a limiting factor, then the same 4 rupees doesn't really matter. In fact, the 4 rupees can even technically become 2 rupees or 1 rupee, because relevant costing approach will say whether that 4 is relevant or not. Maybe you bought it some 10 years back and you have that material, then the relevant cost is realizable value. If the relevant cost is a fast moving item, relevant cost is replacement cost. So different relevant costs can come in. But when I am doing my price variances, I will not change anything. Price variances, you maintain whatever you have been doing. I don't have any problem with price variances, because if you adjust with the price variances, SP will have to add by the same number, AP also will have to add by the same number. The opportunity cost will have to be added at both the places. So I am not bothered about the price variance part, I am not bothered about the labor rate variance part, I am not bothered about the variable overhead expenditure variance, but what matters is your efficiency side. Efficiency is usage side. When you do those variances, the price which you take there will have to be normal standard price plus opportunity cost. The opportunity cost can even be 0. Normally variances are computed by comparing standard cost with actual cost. However, if resources are limited, we should also consider opportunity cost. The opportunity cost is also to be considered for your variance computation. Variance analysis and throughput accounting. What is throughput accounting is, we learnt in theory of constraints that an organization can have constraint. Whenever there is a constraint, it is critical that you use the constraint resource fully. and your non-constraint resources work in line with the constraint resources. They should become subordinate to the main activity, they should be subordinate to the main critical activity, and they should function in line with what is happening to the bottleneck activity. So I cannot afford to waste bottleneck activity. Bottleneck activity is something which should not be wasted, which indirectly means what will happen sometimes is department 1 is not a bottleneck. You will say department 1, you please don't work now. You don't work now because I don't want you to produce. If you produce, department 2 cannot take that. Friends, go there. If department 1 is not working, if department 2 is a bottleneck and department 1 is not a bottleneck, you have so much of resources available with department 1. When so much of resources is available with department 1, what normally happens is department 1 will continuously produce. If it produces, department 2 does not have the capacity. It does not have the capacity and it's a bottleneck activity. So what throughput accounting approach says is that we will voluntarily tell some departments not to work, because and will also ensure that one department continuously work. So when you are voluntarily telling not to work, your efficiency will take a hit. The efficiency or productivity will take a hit. In an approach like just in time, we don't calculate labor efficiency. It's not just in time, but in an approach like just in time, we don't calculate labor efficiency, or we are not bothered about labor efficiency, because under just in time, if I start tracking labor efficiency, laborers will keep producing. But just in time says please produce only what is needed. So under this approach, your efficiency variance will not work. Your efficiency variance is not going to work, because efficiency variance will be there because there is going to be non-utilization of resources. I don't want to utilize department 1 fully. When we did theory of constraints, our machine 3 would have been fully utilized, machine 1 and machine 2 will have idle time. Now you cannot keep saying that I want to use machine 1, I want to use machine 2. So if you are following a throughput kind of an approach, your efficiency variances may not make much sense. Second, what happens here is my objective is that second department or the third department continuously works. I don't want that department to stop at any point of time. When can it stop? It may stop if the second department is not giving the raw material or not giving the WIP. Department 1 will give WIP to department 2. Department 2 will give WIP to department 3. Department 3 will give WIP to department 4. I want to ensure fully that department 3 works. Department 3 should never stop. So for this, organizations will have some buffer inventory to be maintained. So here they are saying we can check under the system. Variance analysis will focus on tracking variation in the inventory buffer which is kept before the constrained resource, so that I don't want the constraint to stop production at any point of time. The constraint should never stop production at any point of time. But your traditional variance analysis may not work that much in case of a TOC kind of an approach, because under TOC approach you are voluntarily stopping production. Advanced manufacturing environment or high technology firms, that is, most of the things become automated. They try to automate things. Now what they are saying is, in case there is too much of automation which has happened, what indirectly is going to happen is majority of the costs which were variable in nature will end up becoming fixed. Majority of the costs which are variable in nature in these type of industries, it will turn out to be fixed cost. There are only two variable overhead variances. What are the two variable overhead variances? Is you have direct material variances and a power cost which is a variable overhead. According to this approach, for example, you see an exam case study where they are saying the company is working under an advanced manufacturing environment, it is having high technology, something like that they end up mentioning, and they tell you to ask labor variances. Labor variances is a fixed overhead. Because under these type of industry, labor is more like a fixed cost. We did one standard costing problem where they said if there is a little change in output, there will not be any change in the labor requirement. So when we did that problem, we treated the labor as a fixed cost. So if an organization is into high technology and all, for them labor will not be a variable cost, but it will be a committed cost. Committed cost is a fixed cost. So this is how it will be linked for problem solving purpose. Okay, service sector standard costing is, the only thing they are saying is in a service sector, lot of things will be non-standardized. You will see that lot of items which are non-standardized in nature. It's not the same product which is continuously manufactured. So if you are in a service industry, your major chunk of the expenses will be overhead expenses and not the production expense. What is production expenses? Is in a manufacturing company, direct material is the main expense, direct labor is the main expense. For Bharadwaj Institute, direct material is not at all there, direct material is not there, and in fact whatever they pay to the faculty, that will also not come under technically under the category direct labor. So majorly your production expenses will not be there. So if you have too much of overheads in an industry, it is critical that these overheads are tracked through a system called as activity based costing. If you follow an activity based costing, you will be able to do effective variance analysis. I think the last part is public sector. What is public sector? Is your PSUs, your government departments. In all that, your standard costing approach may not that much work, but there they are saying we will compare two things. In the government sector, for every expense or for every department, there will be a budget allocation. They will do a budget allocation. You compare the budget allocation with the actual expenditure which has been done. So that is what will be done as far as public sector is concerned. Cost incurred, compare the same with the estimated cost. Estimated cost is basically the budgeted cost to know any variation which has happened. Okay, this factors to be considered when investigating variances. This became a 4-mark exam question in one of the case study in July 21. I think in July 21 they ended up asking factors to be considered for investigating variances. Now what is factors to be considered? You did variance calculation, some are favorable, some are adverse. Now I need to know whether do I need to investigate this variance or not. Investigation is, do I need to do, for example you do variance analysis and it turned out to be 100 rupees adverse. Organization may end up ignoring it. They will end up ignoring it because for doing an investigation you have to spend some money. Because you need a person to do that work. So there is some expenditure which will be incurred, or there will be some opportunity cost. This person could have done something else, you are telling him to do investigation. So there is an expenditure which is going to be incurred on the investigation part. When you incur that expenditure on the investigation part, the end result of the analysis will be that this 100 rupee adverse could have been eliminated, or maybe this 100 adverse will become 90 adverse. So the net benefit is only 10 rupees. So it doesn't really matter. So there are certain things. One, as a rule, what organizations normally do is they try to analyze the size of the variance. What is size of the variance is how bigger is the variance. If something it is a sizable number, you will try to investigate it. If it's not sizable, you may ignore it. The second factor is the type of the variance. Normally organizations focus too much on adverse variances and focus less on favorable variances. So both matters, but as a rule what people normally do is size. Small variation should be ignored. Any large variances should be investigated. Type of variance, adverse variance is given more importance while investigation as compared to favorable variance. If it's an adverse variance, normally the tendency is that let's do an investigation of this. If you get an adverse variance, you will start doing an investigation of this. If it's a favorable variance, you may end up ignoring it also. Favorable variance may end up ignoring. The third benefit is, the third part is cost. There is always an expenditure to be incurred. So if you are doing an investigation and you are going to spend some 1000 rupees on doing that investigation, and the benefit out of this exercise is, see, variance analysis has a benefit. I am not saying a no to it. Short benefit is there because you will get to know what are the factors which have contributed to more profits, what are the factors which have led to decrease in profits, and based on this you may try to do some extra analysis, extra research. All that will be done by organization. I don't have a problem with any of them, but if the variance itself is very less, you will not end up trying to do too much on that. Even at our personal end also, we will have certain things to be done, and if our actual performance is slightly deviating from that, you may not worry much. For example, you maintain a budget, you maintain a cash book of yours which records all your income, all your expenses, whatever inflow comes, whatever expenses come. One day you see a shortage of 5 rupee, you may not try to break your head too much on getting to know what is that 5 rupee for. You may think for a minute, but if you are not getting it, you put a sundry item and then leave it. But if the difference is 5,000 rupees, then you will start thinking, where did this 5,000 go? Because you would want to know the reason for this 5,000, where has this money gone? Pattern and variance. Now what is pattern and variances? A variance happened first time, you ignore it. Second time also it's happening, you may start again ignoring. Third time, fourth time, even that 5 rupees, no, first day happen, second day happen, third day happen, fourth day happen, fifth day happen, sixth day happen. Now if continuously happens, even that 5 rupee will start hitting you, you will start thinking, where did this 5 rupees go? But if it's a one time variance, if it's one time, you will not be bothered. So if there is a continuous variances, if there is a continued pattern of that variances, then you will start again doing investigation. Variances need to be monitored for a period, and if there is a continuous worsening in performance, I cannot I cannot press the panic button by just seeing variance for the first time. You cannot call your sales manager and say that why did you create such a variance. If that's the first time, you may still give it a time. And the last part is there a need to change your budgetary process, or is there a need to change your budget itself? If variation is due to unrealistic or uncontrolled standards, then you need to re-evaluate the standards and not investigate the variance. There is no point in investigating the variance during the COVID time. You cannot keep comparing with the original standard and then say that no organization will do it, because everyone knows the reason for it. There was a need to change only the standards there. This came a 4-mark exam question, so I cannot say from where the questions will come, so that's why entire theory part is very critical. Okay, what are the methods used for investigating variances? The first method is called rule of thumb method, which is very simple. If the variance is beyond a set level, if the variance is beyond a set level, it could be, we have one problem on this also, if it's beyond 4%, 5%, 10%, 15%, some number you decide. If the performance is beyond that level, then there is a need for investigation. Arbitrary criteria: investigate if the variance is greater than a certain amount or a certain percentage based on managerial judgment. Second is statistical decision model. Under the statistical decision model, what happens is, we have two types of system according to them. One system is in control, second is out of control. An organization may decide that I am in control system as of now, or out of control system. In an in control system, what happens is, you believe that system is operating well. I don't want to do any kind of investigation. I believe system is operating well. I don't want to do any kind of investigation. Still, in an in control system, if the variance is huge, you will have to start doing investigation. Out of control system, you believe everything is going wrong in the company. In an out of control system, you believe things are going wrong in the company. So under an out of control system, if things are going wrong, you will start doing investigation. System is not operating fine and corrective action is to be taken. So under an out of control system, you will do investigation for even small variances. Under an in control system, you will do investigation if the things go beyond a set level. If it goes beyond a set level, you will have to start doing investigation. Okay, this is, I think, self-explanatory. You can just read this. This self-explanatory. These variances, interdependencies there. This will help you in doing your when you do your problem solving for interpretation. This will help you. Technically, we have done some interpretation along these questions. These points were considered in few interpretation, but you can just quickly see this. Let me know if you have any doubt on this interdependency. Cheaper quality raw material, skilled worker, composition changed. In case there is any doubt in this interlinkages, this will help you in doing the interpretation of variances. For interpretation of variances, this will become very critical. I think this I had discussed it as part of one question, where I had, I think, some question where we were trying to see what are the reasons for different variances. I think this is exactly from your ICI material. This part is exactly from ICI material. That question which I had discussed, that was picked from SEMA. This is exactly ICI material. Again, you can end up seeing this. You can end up seeing this. Let me know. I think this is more comprehensive. There are extra reasons attached here. There are extra reasons attached here. You can quickly see this. They have ended up giving, this is extremely critical because this can help you in solving or answering an interpretation related question. Any doubts in this interpretation related question, do let me know. This is more comprehensive as compared to what we discussed earlier. And something which you should, nothing to remember, but logically if you can construct these points in a case study, it will help you in getting more marks, because ICI would anticipate you to write these points and be clear on that interdependency, because the interdependency part will have to come in your solution. This is sales variances. In case you want me to discuss any of these items, let me know. All good to know. We have already discussed it, that's why I am not discussing it again, but this may have something extra also. Ideally I should have discussed it rather than discussing that question. Okay, next is behavioral issues. I think behavioral issues, I should go back to only budgetary control. It is no more related to standard costing, but behavioral issues is more related to your budgetary control. One thing with standard costing is it can lead to a lot of blame game. It can lead to a lot of blame game. In fact, I will not be that much happy if an organization is trying to implement standard costing, because what happens in standard costing is you will say this much adverse variation, fix a responsibility for that. When you fix a responsibility for that, indirectly you are questioning me. Indirectly you are questioning me, saying that there's an there's an adverse variance of so much. So I am basically going to be questioned by the organization. There's going to be a question on my performance. They are going to talk about saying that there is some variation which has happened. Please let us know why is this happening. What organization should ideally do is they should bring in this concept of planning and operating 100%. Why planning and operating is needed is, under the modern business environment, you will see a lot of changes happening. Can lead to short term focus due to inherent tendency towards short term results, suboptimal behavior by adding budgetary slack. So these issues you can try to eliminate to some ways through participative budgeting process, but still this can lead to challenges. There are challenges which are likely to come in this when an organization is following something called as budgetary control. Last part, I think this should be the last part, standard costing in modern business environment. The only thing modern business environment says is, the environment in which an entity operates, undergoes a change frequently. The environment in which an entity operates undergoes changes frequently. When the environment changes frequently, the standards which you set may not be the right standards. The standards which you have set may not be the right standards, and that is what we learnt in planning and operating part. Non-standardized product, variance reports may arrive late, outdated standards, Variance analysis may not give full detail, highly automated production. So you will have to continuously change standards. You will have to continuously change standards. There is a need to revise standards in case of the modern business environment. Control ratio is something you would have seen at CA inter level. I've not been doing control ratio in the class problem, but suddenly in an RTP ICA ended up asking control ratio. Control ratio is already explained to you. When I did fixed overhead variances, indirectly I have done something called as control ratio. I'm going to explain that now. Let's assume you have to do FOH variance for this question. Let's assume you have to do FOH variance for this question. If it's FOH variance, is it with calendar or without calendar? Look at information, let me know. With calendar. Okay, this is the problem with calendar. Now with calendar, what you do is SR, SH, AH, PH, BH, and the outer part is your AFOH. SR into SH, SR into AH, SR into PH, SR into BH, and the outer part is called AFOH. This is called expenditure. Expenditure is not a control ratio, I am least bothered about it. All together is called volume. The other name for this is activity. Volume, the other name for this is activity. The first part is called efficiency, capacity, calendar. Now what you calculate, what is the formula for efficiency variance? SR into SH minus SR into AH. Capacity, SR into AH minus SR into PH. Calendar, SR into PH minus SR into BH. Volume, SR into SH minus SR into BH. Please ignore this part for the time being, okay? Just focus on this. Efficiency ratio is equal to standard time by actual time. Efficiency ratio is equal to standard time by actual time. Capacity ratio is equal to actual time by possible time. Actual time by possible time. Calendar ratio is equal to possible time by budgeted time. And volume ratio is equal to standard time by budgeted time. Into 100, if you express in percentage, we normally express in percentage. If this ratio is more than 100%, then it's a favorable situation. For example, if my standard time is 100 hours, actual I am taking lesser, it will be more than 100% efficiency. It's a favorable scenario. So control ratios is equal to efficiency ratio is equal to standard hours by actual hours into 100. Capacity ratio is actual hours by possible hours into 100. Calendar ratio is equal to possible hours by budgeted hours into 100. And volume ratio is equal to SH by BH into 100, or efficiency into capacity into calendar. There you add three things, here you have to multiply 3. Efficiency into capacity into calendar. Quickly put this chart again. Quickly put the chart again. Just put the chart. No computation table. Don't write any computation table. Don't write the computation table. Control ratios is something you have done at CA inter level. There was something called as FOH ratios. Even in a budgetary controls chapter, there were 2-3 questions on these ratios. Let's move to activity based costing now. Now ABC variances basically assumes that most of the overheads are going to be variable in nature. Most of the overheads are going to be variable in nature. They can be variable based on multiple factors. It could be sometimes based on customer deliveries. It can be sometimes based on number of shipments. It can be sometimes based on inspection hours. So you will have to find out what is the driver for it. Once you find the driver, your table will be SR into S. I don't know what is this. It can be CD. CD means customer delivery. It can be IH. IH means inspection hours. it can be S means shipments, it can be, I'll say SR into SS means standard shipments, I'll sometimes say SR into SIH standard inspection hours, sometimes I'll say SCD standard customer delivery. I don't know what I will say, depends on question. Let's assume I'm saying customer delivery, SR into SCD standard customer deliveries, SR into ACD actual customer deliveries, AR into ACD. This is otherwise called as actual variable overhead. This is otherwise called as SR into AO, SR into SO. Mostly we will not use this, but I can technically call them as SR into AO and SR into SO. Standard customer deliveries, actual customer deliveries, and actual customer delivery would be the requirement, and this is what ICA would expect you to do in exam. Even if you do SR into AO, technically you will get the same number. So like what we normally do in a variable overhead problem is we calculate standard rate per unit and standard rate per hour. Now we'll have to do standard rate per unit but not per hour. It can be per customer delivery, per inspection hour, per customer shipment. So multiple factors can be there. You will have to find out what is that factor and then accordingly do the calculation. I wouldn't prefer writing SR into AO, but still if you want to quickly check your answer in your calculator, you can do SR into AO and then check it. But what ICA would expect you to present in exam is SR into standard customer deliveries and SR into actual customer deliveries. Let's look at this. I don't have much to explain. Your expenditure variance formula remains same, efficiency variance. This is expenditure, this is efficiency, all that is remaining same. I don't have any changes. Nothing changes in fixed overhead variance also, because fixed overheads will not come into the activity based costing. Only thing is under fixed overhead variances, if you are following marginal costing, then fixed overhead variances BFOH minus AFOH, only the expenditure variance. You are not going to be bothered about the other variances which are there. They have asked for 4 approaches to reconciliation. One is a conventional method, second relevant cost method in 3 subsection. So particulars, conventional, relevant costing, scarce RM, relevant costing, scarce labor, relevant costing, no scarce inputs. Scarce is basically limiting factor. Particulars, okay, in the particulars, right, budgeted profit, we were planning to sell 2000 units and earn 56, 2000 into 56, budgeted profit. Conventional is basically absorption costing, conventional is traditional method, traditional is absorption costing. Less adverse variances, there are only adverse variances in this question, less adverse variances, material usage, how much was the variance? Minus 8000, material usage, labor efficiency 3200, VOH efficiency, FOH efficiency, FOH capacity, volume will not come, there is no expenditure, sales margin volume variance. How much is SMVV? Absorption costing 11. This is your conventional method, which is your absorption costing. This is your conventional method. Let's quickly check the actual profit number, whether that is right or wrong, because that's not given in the question. What can you tell me the total of this, all this? So actual sales is 18,000 into 208. Subtract the last column of all variances. Actual material cost, actual labor cost, actual variable overhead, actual fixed overhead. 1800 into 208 minus all number. Tell me what is actual profit you get. Actual profit is actual sales minus actual cost. Actual sales is 1800 into 208. Actual cost is last column of all variances. Actual material, actual labor, actual variable overhead, actual fixed overhead. How much you get? $83,600. So this is kind of done. Okay, we're done with the traditional approach. Okay, no scarce input. Relevant costing means marginal costing. Okay, because marginal cost basically represents a relevant cost. No scarce input means I copy this here. No scarce inputs, I copy this here. No efficiency, no capacity, not applicable. No efficiency, no capacity. And what was SMVV under marginal costing? So we are done. This is no scarce input, which is your marginal costing approach. I'll come to scarce input in some time. No scarce input, marginal costing approach. No scarce input is marginal. Relevant costing means marginal costing. In that, no scarce input means no adjustments, no extra adjustments. Follow whatever you have been doing earlier. So you technically copy paste these numbers. Follow whatever you have been doing earlier. Clear? Basically, it's a marginal costing approach without any extra adjustment. Even the relevant costing adjustments are not done. Relevant costing basically means marginal costing approach. There are no scarce input. Coming to situation 2, which is your raw material scarcity. Company wanted to sell 2000 units. Company has sold only 1800 units. As of now, what you are indirectly said is you have sold lesser units. The problem because of selling lesser units is of the sales manager. The problem is sales manager has sold lesser units. These 200 units into 80 rupees of budgeted margin, marginal costing approach, 16,000 adverse is the sales variances. The sales manager came and said, I don't agree to the 16,000 adverse. He came and said, I don't agree to the 16,000 adverse. Why are you making me responsible? He makes a statement, I am ready to sell more units now. I am ready to sell more units. Look at the data and tell me, is it possible for the company to produce more? Is it possible to produce more? Look at the data and let me know, is it possible to produce more? The material is available only to the extent of what we have used. So sales manager is saying, boss, I am not responsible for this. Don't make me responsible for this variance. I am not the person to be made responsible for this. Who is responsible is the person who wasted the raw material. Don't come and ask me that why are you not selling extra 2000 units. I am ready to sell provided you give me the product. So sales manager fought and made this 0. Sales manager has fought and made this 0. He is not agreeing to this variance. He is not ready to agree to this variance. Because we are following marginal costing, these two will not be there. These two will not be there. Now let's assume we are following relevant costing approach. I don't want you to change material price. If at all that was there, copy paste. Labor rate, copy paste. Variable overhead expenditure, copy paste. FOH expenditure, copy paste. None of them I want you to change. Now what happens here is, because this argument is going on now and this guy is not ready to take the blame. The sales manager is not ready to take the blame. What was the standard price per unit of raw material? Standard price per unit of raw material 4. How many kgs were wasted? No, not 200. 2000 kg. No, raw material wasted. So material usage variance is equal to SP into SQ minus SP into AQ. SP was 4 rupees is what you were thinking, but it's not 4 rupees, it's 4 plus another 56. 4 plus another 56 plus another 24 contribution. 4 plus 56 plus 24, that's the contribution you are losing. That's the contribution you are losing. That 80 rupees is for 1 unit. 80 rupees is for 1 unit. 1 unit needs how many raw material? 10 kg. So basically the opportunity cost is 8 rupees per kg of raw material. The opportunity cost is 8 rupees per kg of raw material. 1 unit gives you a contribution of 80 rupees. 1 unit gives you a contribution of 80 rupees. 1 unit also need 10 kgs. So 10 kg can earn you 80 rupees. 1 kg will give you 8 rupees, and if you waste, you will lose 8 rupees. If you waste, you are going to lose 8 rupees. So indirectly 12 into what was the standard quantity you had written? 72,000 minus 12 into 80,000. Indirectly, whatever was that number, whatever was the SMVV, that blame has now shifted to the person who is responsible for material usage variance. Whoever was responsible for material usage variance is indirectly now responsible for SMVV. Is indirectly responsible for SMVV. In short, the opportunity cost is 18,000. Sorry. Standard quantity was 18. Okay, sorry, I took the overall number. 18, 20. So whoever was responsible for SMVV, is that responsibility shifted. Sales manager is not ready to take this on his head and give an explanation. He is not ready to give this explanation because he cannot be held responsible. He is saying, you want me to sell, I am ready to sell. You want me to sell, I am ready to sell, but unfortunately production cannot happen. Clear? Any doubts on this? How much is this number now? So indirectly what has happened is 8,000 became 24,000. This has remained same, this has remained same. This entire 3 variances sat on the head of material usage. The person, whoever is responsible, maybe the production manager has to explain this. Production manager has to explain this. Sales manager is not ready to take up responsibility for this. Your actual profit again will be the same. It will be 83,600. The actual profit is 83,600. FOH efficiency capacity will anyway not come. FOH efficiency and capacity will not come. Ideally, see, what we have indirectly done is, you compare column 2 and column 4. SMVV of 16,000 is shifted to material usage. SMVV of 16,000 we have shifted to material usage variance. We have shifted the SMVV from material usage variance, from SMVV to material usage variance. If this question had material price, no change, copy the same everywhere. Material price variance will not have any change. Labor rate is there, copy paste at all places. Only the variances are going to change from the productivity or the efficiency point of view. Second situation, what is the scarce product? Labor. Again the sales manager says, I don't want to take responsibility. Sales manager is saying, I don't want to take responsibility, but this time there is a discussion goes on, and maybe the sales manager may be held responsible also. But I went to the sales manager, he said, I am not ready to take up responsibility for this. Can you produce more units? The production manager says, I will produce you more units. Why will he produce you more units? Because you had 16,000 hours. How many hours you have utilized? Can you tell me with the balance hours how many units can you produce? With the balance hours, how many units can be produced? 150. These 150 units is the responsibility of SMVV. These 150 units, you have 16,000 hours, you have utilized only 14,800. Balance 1,200 hours are available. Production manager says, I want to produce. Sales manager says, don't produce. Production manager says, I want to produce. Sales manager says, please don't produce. Sales manager says, please don't produce. Why he says don't produce? Because demand is not there. Demand is not there. So now listen. Variation in volume is 200 units. Labor efficiency variance SMVV, labor efficiency, listen for some time, 200 units. The opportunity cost, where will it go? Here 1200 hours divided by 8, 1200 hours divided by 8, what is 1200? 16,000 minus 14,800, 1200 hours which is unutilized, Why did you not utilize? Only possible reason for non-utilization is there was no demand for the product, and that's why you would not have utilized. This had a contribution of 80 rupees. How much is this? 1200 by 8 into 80. 400 hours which you wasted. This will get added to labor efficiency variance. Originally there is a labor efficiency. Additional part is this. This is 4,000 adverse. This is one way of writing it. You just write this first. 200 units. Variation or shortfall in units sold. Shortfall in units sold. Shortfall in units sold 200. Labor efficiency SMVV. Labor efficiency and SMVV. $400 by 8 into 80 and 1200 by 8 into 80. 80 rupees is the contribution. Earlier sales manager said I will not take any responsibility. Now he cannot say that he doesn't want to take any responsibility, because I am going to pass on a part of shortfall to him. In fact, ideally he should take up the full responsibility of all units, 200 units, but now he is ready to argue, saying that some units I am not able to sell, because the production is not happening. So that responsibility will have to go to the production manager. Any doubts till now?
Now given the 400 and 1200.
1200 is the unutilized time, 16,000 hours minus 14,800 hours. 16,000 is the available capacity, 14,800 is unutilized. So if the sales manager wants you to produce, you can produce. If he wants you to produce, you can produce. This is 14,800 actual hours, 14,400 standard hours. 14,800 and 14,400. Any doubts on this? Okay. I will also calculate labor efficiency variance in the normal formula. SR into SH minus SR into AH. One unit needs how many hours? 8 hours. 8 hours was giving a contribution of 80 rupees. 8 hours was giving a contribution of 80 rupees, which means the opportunity cost is 10 rupees per hour. The opportunity cost is 10 rupees per hour. What is the standard rate per hour? Standard rate per hour is how much? How much? 8. Here it will be 18. What is 18? Is 8 rupees of normal cost, 10 rupees of opportunity cost. 8 rupees of normal cost and 10 rupees of opportunity cost. 18 into 14,400 minus 18 into 14,800, which will be your normal labor efficiency variance plus that 4,000 opportunity cost. Extra 4,000 is the opportunity. How much is this? 7,000. Clear? Yeah. 4 plus 8, 12, no? Look at the calculation. Sure. Any doubts on this? Okay. So now it kind of ends here. Material usage, I am basically first copy pasting these numbers. Efficiency becomes 7,200 and this becomes 12,000. Efficiency becomes 7,200 and this becomes 12,000. Marginal costing would mean, relevant costing would mean marginal costing approach. And if you don't have scarce input, you're kind of done. If you have scarce input, you'll have to do calculation like this. No changes as far as material price. So if a problem asks you relevant costing, first do your traditional variances fully, complete them. If they ask conventional method, absorption. If they ask you relevant costing method, marginal. In that, no limiting factor, yes limiting factor can be two situations.